markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. After 8 days of gains, S&P 500, right now it's lower. Investors in something of a holding pattern for this afternoon. Around 2 Eastern, we're going to get some words from the Fed Chair, Jerome Powell, maybe delivering something on monetary policy, maybe not. With 453 companies in the S&P 500 reporting so far this season, 82% have delivered positive earnings surprises. Walt Disney is gaining by the most in a year. They had better than expected profits. Also going to cut expenses. Shares of Disney right now up 7%. Also, we have, meantime, a prediction from the co-chief investment officer at GAMCO, Chris Marangi, sees a wave of consolidation in that media space.
There's going to be consolidation in media for sure, especially amongst the streaming names. Don't know when that happens. It's probably over the next few years. Obviously, you have an FTC, which has been allergic to consolidation. That, of course, may change, but it's inevitable.
Right now, we have the 2-year up 3 basis points, 496. 10-year, 8 basis points higher. That rise at 456, keeping a lid on the stocks. And then you have palladium dropping below $1,000 an ounce for the first time in 5 years.
So
what
weird.
do they use palladium for?
Catalytic converters.
Very good. And with a switch to electric cars,
it's less necessary.
That you've done a brilliant analysis.
Thank you.
On the price swings in palladium. Right now, the S&P 500 down 10. The Dow 115 points lower. The NASDAQ 122 points lower. I mean, it's more than that, but you get the essentials.
You know, for a while, people were stealing catalytic converters.
Oh, yeah.
Because palladium was so valuable.
And you can also use a different metal at this. I forget what it was, but you can.
I invite those thieves to my house. Please take my catalytic converters.
Why?
Because then I have a lot more flow for the engine. You know, I can produce more power.
Oh, so
let's move forward.
The installation of the catalytic converter takes away from the Vroom factor?
Yes, it does.
I did not know that.
That's why I have a Scat Pack. All right. John Tucker, thank you so much. We appreciate it. Matt Miller, Paul Sweeney live here in the Bloomberg Interactive Brokers studio, streaming live on YouTube as well. All right. Disney reported numbers last night. I thought pretty good. They're cutting costs, so the stock's up. But quite frankly, folks, I've been doing this media stuff for almost 30 years. I have no idea how these companies are going to transition to this new streaming model, but who cares? Because we have somebody who's really, really smart on this stuff. Michael Nathanson, he's a founding partner and senior research analyst at MoffettNathanson. Michael, thanks so much for joining us here. Again, I'm like most investors, like I don't know where to go with these media stocks. What did you hear from Disney last night?
Well, I think what we heard from Disney that made a difference was they gave you cash flow guidance that made people feel more comfortable with the valuation. And you also heard that they're going to spend less on content going forward. And again, like it feels to us, and you said this before about streaming, there was just overspending on streaming. People were throwing money at it left and right. And it feels to me that there's some rationality coming back and that Disney is going to spend less on cash content spend. And that's going to basically drive free cash flow. And to me, if you look at Disney's earnings, it's essentially a parks company. So I don't want them blowing money on streaming if there's no return on capital. So I'm pretty happy with this outcome because we've been saying forever, like this is a parks company and media is becoming less and less important here because it's going down every day in terms of profitability, as you know very well.
So is it important to you to know whether they're in or out of streaming? A lot of people have said, I want to know, their strategy in regards to streaming. Netflix obviously also spends like a drunken sailor on content creating, but Netflix rules the roost, right? So, I mean, what's the point of spending less? Why not just be out of it?
Well, they can't, at this point, they can't be out of it. They, their view is that Disney should have a direct relationship with consumers as they do in the theme parks, right? And for the long history of media, Disney never knew its true consumers, right? It was always a third party was doing distribution. So I think Disney can't be out of it. The question is, how much should Disney be in it, right? Should they be competing with Netflix or should they be a smaller, more targeted service for Disney superfans? And that's been our contention all along. You don't have to be Netflix. You have to make a Disney Plus product for your core fans. There's less of them. You can charge more money, That's probably a better business. And we've been saying that, like, do not be Netflix. It's not a business you want to be in. And they're listening, I think. I think they're realizing that they have a great, great business model as is, and they need to basically just make sure their fans are being nourished, not overspend on things that are not core.
All right, so if they're going to be focusing on their core fans primarily through their parks business, what do you do with all the other stuff? They've kind of got a big studio operation. They kind of got a bunch of linear cable and broadcast networks. What do you do with all that stuff?
Okay, well, studio is key because if you think about, you've known this for your studio is a way to refresh the characters in the park. Like the flywheel starts with studio and IP.
It has to happen. I watched Cinderella last night, by the way, with my 3-year-old daughter. And at one point, one mouse says, "Let's leave the sewing to the women." And I thought, oh, I should not be showing her the 1950 version.
No, well, there's a long list of movies from that era you should not be showing her for that same reason. But the view is, look, we've been debating with the company openly that we don't know why ABC and ESPN need to be part of that new company, right? And the company has not really said what they want to sell. But like our theory is at the heart of Disney is the IP. Then you have consumer products and theme parks and films. But that business is worth a lot. And then the other businesses that you see from valuations of all the peers isn't worth that much, right? They like sports. They like ESPN. That sounds like it's staying. But like there's still open debate about what do they do with ABC and the Fox assets they bought. And that's not going to end anytime soon. But our point has been, it doesn't really much matter because the core is, studio, film, Disney Plus, and those other assets are so lowly valued that it's not going to matter. You really need to stop the wasteful spending and streaming and focus on the core, which is what we heard last night.
So another issue, Michael, is Bob Iger. We love him. He's been great for shareholders. He's kind of put himself in a box once again in terms of timing and succession. Anything new there? Do we read anything into this new external CFO being hired? How do you think about that now?
Yeah, it's a good question. The CFO externally is interesting because I don't think there's been an external CFO in 25, 30 years, in a long, long time. So I think that person is going to come in, Hugh Johnson from Pepsi, is going to come in and look at the cost structure. I don't see him. I don't know him, but I don't see that as an heir replacement for Bob. I think the question is going to be, for the new CFO, where is their wasteful spending? What can he do to bring kind of a Pepsi discipline to Disney? But I still think you still have an open question about who replaces Bob. It's not easy because of the diversity of operations. We've been saying, look, maybe you break the thing into two again. And I think if that's the case, the park side will rise in value in terms of the management team. But I think as the company stays as Disney, they don't change the structure. It's a hard job to fill. Yeah. I don't think the new CFO is on that short list yet because he's never worked in this industry before.
Sure. All right, looks like everybody's back to work in Hollywood, first the writers and now the actors. How is this going to play out over the next several quarters in terms of production and releases and all that stuff?
That's a good question. I'm amazed that it's been firstly so long, that the strike has taken so long to resolve because it's been really damaging to the ecosystem. I think people get back to work in the next, you have Thanksgiving coming up, right? So probably December, January, you probably get yourself a content slate and output that starts looking more normal by the February timeframe. But you basically just had 6 months of training people not to watch broadcast TV for content, not to go to the theaters, right? Anything besides Barbie and Oppenheimer. I think it's just really bad. I think people do change behavior, and it's hard to get them back. And so, people will be back working, but I worry about what happens on the other side of this. I really do.
All right, Michael. Always appreciate getting a few minutes of your time. Some of the really, really most thoughtful research out there, in my opinion, on the media entertainment space. Michael Nathanson, he's a founding partner and senior research analyst with MoffettNathanson. Good news from Disney last night. The stock is up 7% here today. Although it's only up 4% year to date, kind of reflecting a lot of investors still remain really unsure as to the trajectory for this industry as it tries to pivot from the traditional media model that they had all enjoyed over the last 30, 40 years, which is you and me paying $80, $100 a month to our cable company, and that a lot of that flowing right to the media company. So that model is no longer in the forefront here. It's all about streaming, and there are different economics there, and these companies and these investors are trying to figure out how that really plays out over time. Michael Nathanson, really one of the top folks on the street. This is Bloomberg. get some company news right now with Denise Pellegrini.
Yeah, and Disney is certainly one of the stocks driving the market right now. As you mentioned, it's higher. It's up by about 7%. And one other question is how Disney will manage to pay for that third of Hulu it doesn't already own. And those talks are still in negotiation. Morgan Stanley under the microscope. We're hearing the Federal Reserve is scrutinizing the bank and its wealth management business and whether or not it is doing enough to prevent potential money laundering by wealthy clients from outside the U.S. We get more on what's happening there from Bloomberg's Tom Busby.
Sources say the New York Fed's top regulator is pressing Morgan Stanley to improve controls and processes. Now, a source also tells us Fed officials have already privately reprimanded Morgan Stanley for not making all of the changes it sought. Representatives for the Fed and the bank declined to comment. The wealth business, key for Morgan Stanley. It's responsible for almost half the company's revenue over the last year. Tom Busby, Bloomberg Radio.
All right, thank you, Tom. And shares of Morgan Stanley, they are down by about 1% right now. Amazon is cutting jobs again, this time in its music division. A source tells us the cuts are in Amazon's music, editorial, and audio content team. Now, last year, you remember, Amazon initiated its biggest ever corporate job cuts. It expanded that to 27,000 positions. And as we've been reporting, the strike is over. Hollywood studios and the union for some 160,000 actors have reached an agreement to end a strike that started over the summer. The union says that the committee has approved the tentative deal by unanimous vote. This means production of scripted TV shows and movies can resume soon, but watch for delays. And those are some of the company stories we're following this hour.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, Matt Miller and Paul Sweeney live here in the Bloomberg studio here in New York City. S&P 500 off about just 0.1%. NASDAQ pretty much unchanged. A little bit of red out there. Looking at yields. Yields a little bit higher here. The 10-year Treasury up about 7 basis points, 4.55%. And WTI crude oil finding a little bit of a floor here. It's up 1.75%, $76.60 for WTI crude oil. And Bitcoin, how about that? Up 4.7%, $37,275 per token. So a nice move higher in Bitcoin. With our news in New York City, here's Michael Barr.
Thank you very much, Paul and Matt. 5 Republican presidential candidates used the third debate of the GOP primary campaign to show their support for Israel. Former New Jersey Governor Chris Christie on NBC.
America is here, no matter what it is you need at any time, to preserve the state of Israel.
They also displayed at least some willingness to criticize Donald Trump, the front runner in the race, who was not there at the Miami debate. Instead, Trump held a campaign rally nearby.
In times like these, you can't afford to have a president who wants to be politically correct. We have to do things properly.
Trump spoke in Hialeah. In Hollywood, the Actors Union has reached a tentative agreement with studios to end the strike. The deal brings an end to 4 months of labor strife that has hobbled production in Hollywood. Elaine Lowe is a staff writer at the Hollywood trade publication The Angler.
I'm told by sources in the room that the mood is jubilant, that there are very tired tears. This was, of course, a unanimous vote. It was 17-0 in favor of this package after many days of deliberation, after the studios had presented their quote unquote last, best and final offer to the Performers Union on Saturday.
The deal, which provides AI protections for actors, must still be approved by the union's board and its members. Increasing workplace flexibility may lower an older worker's risk of heart disease or stroke. That's according to a new study from researchers at Harvard and Penn State University. Study author Lisa Berkman is a Harvard professor of epidemiology.
We developed teams of workers, so workers got together and decided how they could increase workplace flexibility and schedule control.
The study is among the first to assess whether changes to work environment can affect heart disease risk. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Paul, Matt.
Hey, Michael Barr, thank you so much. We appreciate that. Matt Miller and Paul Sweeney here. Weight loss market, that weight loss drug market, is getting competitive. So an effective and massively popular weight loss drug has made Novo Nordisk billions of dollars and turned it into the most valuable company in Europe, with the U.S. Food and Drug Administration approval of another option from Eli Lilly and Company on Wednesday. The Danish drug maker now has some serious competition. So Lilly is going to bring its product out at a price that is 21% less or about than what we're getting from the Novo Nordisk. So this is getting competitive out there, and prices looks like are coming down, Matt. So I know you're interested in this stuff.
Yeah, absolutely. And I think prices are going to only come down further, right? Because because Medicare is going to directly negotiate with drug makers, and because of competition, that's how the market should work. I wonder how many people are going to start taking it, because yesterday we were talking with Sam Fazeli, and he said, you know, it was only a small portion of the population, not enough to drive, you know, in his view, the kind of moves that we've seen at like Walmart or PepsiCo, for example.
That all seemed kind of silly to me. I just never thought it would be that material.
Totally.
But if you put it in a pill format, then you're talking something different, I think. You know, and if it goes...
Well, it is. Novo Nordisk does have a pill format.
It does? Okay.
But it just... it may not work quite as well as the injectable, and they have to use higher doses. They're trying to mess with the formula to make it better. But yeah, at some point...
And they're going to figure this out, and they're going to figure it out in a way that's really, really convenient for people. And when you get to that point, then maybe you've got something that can really be impactful here. But I mean, how many people are looking for any solution to fight their weight? And boy, they're going to jump at this one, I would think. And we've already seen it already with some of these drugs that are on the market already. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, we've got Alice Andres. She's an FX and rates reporter with Bloomberg News. She's based in Chicago. We've got her in our New York studio today, so how good is that? You know, when we see people, Matt, that aren't ordinarily in our New York studio, when we see them walk by, we literally just grab them, bring them into the studio. That's kind of how that works out. Elliot Stein's going to join us. He's a senior litigation analyst at Bloomberg Intelligence. Can talk about Morgan Stanley Wealth Management arm is drawing some Fed scrutiny, and not in the good way. Plus, Selma Hepp, she's going to join us. She's a chief economist at CoreLogic to talk about the housing market out there and what's happening. But right now, let's kick this whole thing off with Mr. John Tucker and a Bloomberg Business Flash.
All right, thanks, Matt and Paul. Treasury yields are higher. Let's start there, because that's keeping a lid on stocks, so it seems. Right now, the 10-year, 7 basis points higher, 4.55 right now. The 2 up 2 at 4.95. And then you have investors also seem to be on the sidelines right now, waiting for any crumbs of wisdom on monetary policy from the Fed Chair, Jerome Powell. He is set to speak around 2 o'clock. Eastern time. Oil recovering after plunging to a 3-month low. Energy right now is the best performing industry group in the S&P 500. Meantime, Cameron Dawson at New Edge Wealth is looking for a stock rally ahead.
We can expect some kind of Santa Claus rally just because of tax loss dynamics into the end of the year, which means that you don't have eager sellers to recognize tax gains. This is very different than last year, where the largest weights in the index were down a lot, people sold them, and you effectively puked into the end of the year.
Right now, the S&P 500, 2 points lower, 43.80 on the index. The Dow, 40 points lower. The NASDAQ 100, that is turned higher, up 13 points. That's up just about 0.1%. Tesla sinking amid a bearish analyst call. NVIDIA rallying on a report of artificial intelligence chips for China. And it's the art selling season, the auction time.
Oh, yeah.
A 1932 painting by Picasso, Femme à la Montre, sold for $139.3 million last night.
What?
At Sotheby's. In a stroke, it becomes the second most expensive piece by Picasso to sell.
That's what the guy yesterday we had
at
in here
auction
talking about.
Yeah, I mean, this always surprises me because Sotheby's is going to auction a collection of cars on Monday night, and they're expected to get about $60 million, maybe 50, for a Ferrari 250 GEO. That will be the highest price ever paid for a Ferrari at auction.
But you can't hang it on your wall. But then again, you can't drive it.
You can't drive the painting, so I don't understand why people... Yeah, I don't get that.
All right.
I mean, I'm sure it's a pretty painting.
It features his girlfriend wearing a wristwatch. That's the painting.
I feel like a print would suffice, you know?
Yes, exactly. John Tucker, thank you so much. We appreciate it. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Brokers studio. We're streaming live on YouTube, so head over to youtube.com and search Bloomberg Radio. All right, smart bond people like Lisa Abramowitz and, I don't know.
Liz
Capo
McCormick.
Yeah, they tell me I got to pay attention to bond auctions. I can't do it. These treasury auctions, I just can't.
You know, my problem is the data that we get. You know, it says like...
yeah, I don't know.
Direct bidders at 69.4%, indirect at 16.2%. I mean, what does that even mean?
That's why we have people like Alice Andres joins us. She's a U.S. interest rate and foreign exchange reporter for Bloomberg News. Alice, tell us why these treasury auctions are important and what are you seeing from them these days?
Right. Well, I'll tell you exactly what these indirect bidders and direct bidders are, okay?
Thank you.
So basically, you can just think of the two groups, end users. Okay, so if you put the two together, indirect bidders, direct bidders, they're the end users. The other part of the bidding for these auctions will be the dealers, right? So the dealers will buy the auctions. Maybe they get a little bit too many. Maybe they don't get enough. And then you see like the movement after the auction. That's all the dealers either getting rid of this paper that they got a little bit too much of, or they didn't get enough, so now they got to scramble and buy this paper because they need it. So I think that what you want to
But
think
do you
about,
want more? Like, is it better to have 70% indirect and 15% direct, or would we rather have 60% indirect and 25% direct?
Okay. Well, so I think that what you want to do is you really want to take the two together. Okay.
Okay.
And what we were started to see earlier in the year was that about 90% of these auctions went to directs and indirects. Okay, what that tells you is that those auctions are in very solid hands, because these are the users that are going to buy these auctions, buy this paper, hold it, and clip these coupons. Okay, so what it really tells you is that these auctions are in pretty good hands. So U.S. government debt is in hands that's going to keep it and clip the coupons.
Let's talk about the red headline that comes out after every auction. It always says, let U.S. 3-year notes draw 4.701%, semicolon, allotted at high 4.28%. What does that mean?
Right, so that means that the allotment at whatever percentage went at that yield level. So that just tells you, I would say that that's probably not the most important headline. Things that I like to look at, of course, I would look at the distribution among the directs, indirects, and the dealers, right? And like I said, if dealers get too many, they're going to sell the paper. You're going to see the bond market sell off. The other thing you want to take a look at is this, the bid to cover ratio. So if the bid to cover ratio is higher than the former auction, then you know that demand was pretty good. And that's another indication.
And that's what we've seen, I mean, yesterday, for example, we saw that.
Right, and so you could say that in addition to the bond auction going into strong hands, these end user accounts, the bid to cover was strong, meaning that there was more bidders than was offered.
I'll look at also a GIP of the yield. So if, the yield continues to come down after the auction, then I feel like it probably went pretty well.
Yes, that would be another good indication. What we would call that is a follow through. Okay, maybe some people that didn't get the auction are buying post-auction.
All right, I just focus on where the interest rate's going, but I get this whole auction thing. What are the auctions telling us over the last several auctions? Again, Ira Jersey at Bloomberg Intelligence says we got to focus on this. He always wants to hype it. What's it been telling us about some of these auctions and the health of the market?
Well, so I would say that the last couple of auctions, we did have 3s and 10s this week. They were pretty good, especially the 3-year auction. That's actually been a sector where we've been seeing some important money like central banks move. Probably not a big surprise to move into the shorter end of the market. 10s were not as great yesterday, but still pretty decent. Today's auction, this 30-year paper, this is going to be really tough. It's a long duration piece of government debt. That's always kind of hard to auction. The other thing is totally handicapped right in front of Powell. He'll speak at 2 the auctions at once. So it's just like, it's so hard to take down that kind of duration right in front of Powell. So I would actually say that this auction is going to tail, and that's another buzzword that we use in the auction. So a tail meaning that the yield came in for the auction it came in higher than where it was at 1 p.m.
All right, they're not willing to pay more.
Correct.
They want to pay less
Correct.
for the paper.
Who buys our stuff these days? Who buys our auctions? Like, who shows up?
Asset managers.
Okay.
Central banks.
Asset managers in Japan?
Could be.
In China?
All around the world.
Are they still big buyers, though? Because for a long time, when I looked at, what do I type? Debt Go, right? And I try and see, who's holding U.S. Treasuries. You'll see a lot of foreign buyers, and that kind of shriveled up recently. Yeah. Obviously, the Federal Reserve buys the most,
that's a good
right?
One. I like that function.
Yeah.
Yeah, you look at Debt Go and see that our Fed
owns?
buys all of our debt. So it's like they just take money out of one pocket and put it in the other.
All right, what's the next thing we need to pay attention to, Alice, in terms of, your marketplace? What are you looking at over the next several days?
Yeah. So what I'm looking at is I'm going to look at where yields are going to finish the week, specifically on 10s. If we trade through 451 on 10s this week, then I would probably look for a little bit more of an extension of this bond market rally. I'd look for yields to fall about 15 to 20 basis points. Reason being, you know, we're falling right back into like a very comfortable range. That 450 to 475 range was really comfortable. We spent a lot of the year there, and this move up to 5% just really wasn't like a super comfortable place for the bond market. And, you know, we had a couple stories on the terminal out that JP Morgan is saying that if we can, you know, keep rates right around here, probably early next week, we'll see about $92 billion in buying from CTAs in the Treasury market, probably concentrated in 10s. That'll certainly, you know, make a dent on yields. Also, probably we've seen continued asset manager buying since October 31st. If CTAs get on board, you better believe you're going to have other momentum followers come on, and asset managers will feel like they have to grab some too. And also, the JP Morgan Treasury Client Survey has shown its biggest long since June. And so I think that you're going to see an extension of the rally if we can close, you know, through 451 on Friday.
All right, very good. We'll pay attention to that. Alice, Andres?
You know what else you can do? Use the ECAN function. ECAN Go, ECAN Go. And if you do that, there's a drop-down menu, U.S. Treasury note and bond issuance. You can also look at U.S. Treasury bills issuance.
I got enough on my plate.
Dude, it is awesome. Like when Al's saying, like, look at the 10s. So I go here, I click on into the 10s, and then I can see the history also of indirect, direct primaries. You can see primary takedown is shrinking, right? It's a lot more indirect bidders than it has been in the past years.
Alice Andres, thank you so much for joining us. U.S. interest rates and foreign exchange reporter, Bloomberg News, joining us here live in New York. Also joining us live right here is Elliot Stein, the pride of Stanford University, and coming to the ACC, so go figure that out. Elliot Stein, senior litigation
Wait a second,
analyst.
Stanford
And Cal are coming to the ACC.
Isn't that the Atlantic?
Yes, thank you.
Oh.
It makes no sense. It makes no sense, but you know, it's who knows what's going on. All right, talk to us about Morgan Stanley. I was reading something that maybe some regulators are looking at their asset management business.
Yeah. So yesterday, the Wall Street Journal, broke a story that the Federal Reserve has been looking at Morgan Stanley's wealth management business. In particular, it's money laundering controls, right? And they're concerned about rich clients. It seems that they're maybe focused on Latin America and South America. And apparently this has been going on for a few years, but we're only learning about it now because it seems like the Fed is not satisfied that Morgan Stanley has bolstered its AML controls sufficiently.
I mean, having worked in Wall Street firms my entire life, we get grilled on this every single year. And even here at Bloomberg, it's part of our training. I mean, it's just, you're knocked over the head with this stuff.
Yet they slipped through. And yet money laundering still happened at the big Wall Street banks.
Exactly.
So I guess you're not grilled enough.
Yeah, exactly. I mean, every bank is always being investigated for this stuff in some way or another, right? Sometimes it usually gets nipped in the bud pretty quickly. Here, it sounds like the Fed and Morgan Stanley have been having a conversation for at least 3 years about this particular issue. Morgan Stanley, keeps coming back to them saying, here's what we're doing to fix it. And I guess the Fed keeps saying, you need to do more. It's a little unclear where things stand now. It sounds like Morgan Stanley is still in this window that they've told the Fed they're going to, fix the situation. But if it doesn't get fixed, as we've seen historically, then you'll see a penalty down the road.
All right. So what about other banks? Are we gonna see more and more go under the microscope?
Yeah. I mean, look, all of them are always under the microscope. I mean, just recently we've, Bloomberg had a story in September about UBS and Credit Suisse's controls with respect to potential sanctions violations related to Russia. We haven't heard too much more about that, and the banks have denied that it's an issue, so we'll see if more comes out on that. Deutsche Bank, just earlier this year in July, was fined about $186 million by the Federal Reserve, again, for not fixing previous issues that it had, because it was fined in 2015 and in 2017 for sanctions violations and AML problems. And so, again, these things are just recurring issues all the time.
So reality from a legal perspective historically have these things ever been a material risk? Material risk to their stock or their bonds or anything like that?
Usually not. I mean, you know, a lot of these are sort of just the cost of doing business. You think about the example I just mentioned, Deutsche Bank's $186 million. That's, you know, not a huge amount. Some other cases wind up being more. Danske Bank paid about $1 billion last year for all sorts of money laundering issues and bank fraud issues. So sometimes it does rise to the level where it is more material for a bank, but a lot of times we're talking about low $100 million, which for the banks is not, you know, too bad.
All right, so what else are you looking at here? What else are you guys working on there in terms of kind of looking at some of the litigation risk out there for financials?
You know, the SEC obviously has been super active, right? I mean, they have a lawsuit against Coinbase. They sued Virtu a couple months ago. And just generally, you know...
Like, I thought the SEC would be, I don't know, more supportive or constructive towards crypto. Gary Gensler, I kind of thought, or a lot of folks thought that he understood crypto, maybe he saw the value in crypto, but that's not necessarily been the case, has it?
Yeah, you know, I mean, the main critique is that they have been going after crypto on an enforcement basis rather than coming out with a rule-making process, which would, you know, sort of make things clearer for the whole industry in one fell swoop. But instead, they're sort of, you know, going after players like piecemeal, and then you don't really get the full clarity that you would otherwise.
Yeah, I think the idea is that he understood crypto, but that doesn't necessarily mean that he doesn't think it's a Ponzi scheme.
Okay, I get it. So I guess, I mean, the issue I kind of feel like the crypto space is kind of yearning for some structure.
For sure.
Wouldn't you like to know where the guardrails are?
Well, some of it is, right?
Yes.
The rest of it just wants to keep on doing rug pulls and scams.
Right. But I think the big players like Coinbase in particular, you know, they really have been screaming for rules and regulations around this stuff for a while. And what's interesting is this SEC under Gary Gensler, I think, has promulgated the most rules of any SEC in recent memory. But there's obviously one, you know, glaring absence, and that's crypto.
Yeah, also, they want rules at Coinbase, but they don't want a rule that says staking Ethereum is a security. So
right, yeah,
there are certain rules they want and other rules they really don't.
That's absolutely right. I mean, we'll see what rules actually come out, because then, guess what? They'll probably sue over those rules and say that the SEC exceeded its authority.
Exactly.
All right, Elliot, thanks so much for joining us. Elliot Stein, he's a senior litigation analyst. He looks at the financial industries, and there's lots of litigation around the big financial companies out there, so we stay on top of that. He does that for Bloomberg Intelligence, and he's joining us live here in our Bloomberg Interactive Broker Studio. Good stuff. S&P 500 up 0.1%. The Dow unched on the day. NASDAQ up about 0.2% here. Yields a little bit higher. The 10-year Treasury is now yielding 4.55%. That's up about 8 basis points here today. You're going to have more from Bloomberg. This is Bloomberg. Let's get some company news right now with Denise Pellegrini.
Yeah, and one of the things we're watching very closely this hour, you've been talking about it here on Bloomberg Markets, is Disney shares are surging right now after a profit beat. And Michael Nathanson, founding partner and senior research analyst at MoffettNathanson, telling us here on Bloomberg Markets, the $2 billion more in cost cutting that Disney announced is key here.
They gave you cash flow guidance that made people feel more comfortable with the valuation. And you also heard that they're going to spend less on content going forward. There was just overspending on streaming. People were throwing money at it left and right. And it feels to me that there's some rationality coming back, and that Disney is going to spend less on cash content spend. And that's going to basically drive free cash flow.
And Nathanson of MoffettNathanson there on Bloomberg Markets. And Disney shares, they are up about 7% right now. Another weight loss drug could soon come to market. We'll see. This one is a pill, though, so it's getting a lot of interest. We get more on that from Bloomberg's Ann Cates.
AstraZeneca has landed a deal to develop a drug from the pharma industry's hottest class of medicines and says the experimental obesity pill is potentially cheaper than current blockbuster shots. The pill form treatment developed by Chinese biotech company Ecogene is an early-stage clinical test for diabetes. Astra has agreed to spend as much as $2 billion for the medicine. Some analysts predict the class of treatments known as GLP-1s could become one of the biggest ever blockbuster medicines. Rival Pfizer expects to report mid-stage clinical trial data on its own experimental pill. Both of these on top of the increasingly popular shots known as Ozempic and Wegovy. Ann Cates, Bloomberg Radio.
Profits. Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Right now, the major averages, we'll call it mixed after 8 straight days of advances. S&P 500 up right now, not by much, though, just 2 points higher. Fed Chief Jay Powell, he speaks at 2 p.m. Wall Street time. We're going to be dissecting that speech for any clues on monetary policies. As far as the betting goes, the swaps traders are betting the steepest tightening cycle in a generation is over and done with, and that easing will begin sometime mid next year. Information technology right now, the best performing industry group in the S&P 500. That's where you're going to find shares of NVIDIA Corporation. They are up 2 3/4%. Overall, S&P 500 up 43.85 in the index. The Dow down 9 at 34,102. The Nasdaq 138 points higher. That is up 0.25%. The 10-year yield 7 basis points higher, 4.55 there. The 2-year up 3 basis points. That's at 4.96. Good wishes out to the Woz. Apple co-founder Steve Wozniak hospitalized in Mexico. There are reports the 73-year-old had a stroke, so wish him good wishes there.
Absolutely. John Tucker, thank you so much. We appreciate that. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Brokers studio, streaming also on YouTube. And we're also now in your dashboard with Apple CarPlay and Android Audio. It gives you access to every Bloomberg podcast, live audio feeds from Bloomberg Radio, print stories from Bloomberg News in audio form, and the latest headlines at the click of a button with Bloomberg News Now. How do you get it? Well, it's free. That's good. With the latest version of the Bloomberg Business app. So go get the Bloomberg Business app. Get it on your phone in the Apple App Store or on Google Play. Just download the app, connect your phone to your car, and get started. And it's all presented by our sponsor, Interactive Broker Studio. So we appreciate that. Looking at the Bankrate.com U.S. home mortgage 30-year fixed national average, 7.83%. Still amazingly high given where we were over the last dozen years or so, but below where it was just a week or so ago at 8.09%, which was the peak. But I don't know what you do out there in the residential real estate market these days. So let's talk to somebody who does think about this stuff. Selma Hepp joins us. She's a chief economist for CoreLogic. Selma, as you step back here and look at a market that has mortgage rates, yes, they're off their peak, but they're still way higher than most consumers are used to. What's kind of the outlook for the residential real estate market?
Yeah, I mean, it's really interesting to see that, in light of mortgage rates being so high, at this point in seasonal trend, we continue to see home sales pretty steady. I mean, at this time last year, we saw a considerable decline in home sales activity, which we do tend to see in fall or late or winter. But we're not seeing that to the same extent this time around. So it does feel like home sales are bottoming out. I think people are accepting the fact that rates are what they are. And also, they have been very responsive to declining mortgage rates. So when mortgage rates did fall down some over the last week, there's been an increase in mortgage purchase applications. So people are really, keeping their ear out for what's happening with mortgage rates, are very responsive to that.
What are you seeing in terms of the other market? It seems like the bifurcation of the housing market has been huge. In terms of existing homes, it's ground to a halt. In terms of new homes, are builders, doing as much as they possibly can to boost supply, and is that going quickly?
Well, I'm not sure that it's going quickly enough. We have seen decline in new construction compared to last couple of years because of the fear of what the impact of mortgage rates is going to be. But builders are stepping in aggressively and providing mortgage rate buy downs, which is helping bring home buyers in. So in terms of the supply, they are absorbing the supply that they have, and they're pretty optimistic in terms of when mortgage rates come down, what does it mean for for the demand going forward. I mean, we do have a considerable amount of pent-up demand, given how low home sales activity has been over the last year or so. And, you know, we still have that demographic force and baby boomer force that's still sitting out there waiting for mortgage rates to come down. So, I mean, I think longer term outlook is pretty positive. I just worry, you know, the winter is going to be pretty cold.
Right. And, you know, I guess a lot of folks, when I talk to real estate agents, they're just saying, you know, there's not a lot of activity because of where rates are. And I guess the question that I hear or that I give them is there a rate where you think you might start unfreezing this market? Like if the mortgage rates gets back to 6% or even 5%, would that free up and start moving some inventory that's in the available market?
Yes, I think so. I mean, you've seen that at the beginning of this year when mortgage rates came down from 7 to 6, we saw a lot of people coming in. Now, in terms of the inventory, I'm not sure to what extent that's going to change considerably at this time. I mean, we still have, you know, when you think about how many people out there, you know, 2/3 of population are homeowners, and about 90% of them have mortgage rates below 6%. So it's, you know, it's going to take a while for that to unfold. But I do think that with each drop, I think people become more optimistic and more willing to do something. The other thing is in terms of inventory, new listings in particular, we are seeing leveling off of new listings as well, meaning that given the seasonality and the expectation that this time of the year you'd see a significant drop in new listings, we're not necessarily seeing that. So new listings are bottoming out as well, meaning that when we come in spring home buying season, we may in fact have a little bit more inventory than we had last spring. So that will housing market activity too.
What kind of, in terms of mortgages, right? I've been talking to a lot of international folks lately who say, man, you guys have this really great 30-year mortgage in the U.S. That product doesn't exist in a lot of other countries because we as taxpayers subsidize it. And I don't know if that's the right thing to do, but whatever. Are people buying more variable rate mortgages? Are you seeing more ARMs, adjustable rate mortgages sold now?
Well, we definitely did see that at the end of last year when there was the initial shock of higher mortgage rates. We are seeing a little bit less of that. I mean, it's still at the elevated level compared to, you know, a couple of years ago when mortgage rates, you know, hit the rock bottom. So it's still higher than that, but not as much as we saw at the end of last year.
Summer, what's going on with the rents out there? If I'm going to go rent someplace, am I paying more than I did a year ago? Less? Where are we here?
The rent growth has slowed considerably, and in some markets is declining. But I mean, on average, I think, you know, we have CoreLogic has single family rent index that we put out every month, and it's still positive, meaning that on a year-over-year basis, you would be paying a couple % more than you were paying last year. So rents are still growing. I mean, what's really interesting in terms of rent versus home prices is that home prices continue to be so strong. You know, CoreLogic did we released our home price index earlier this week and showed home prices up 4.5% on a year-over-year basis. But what's more interesting is that from the beginning of this year, home prices are up 6%, and in some markets, home prices are up as much as 7 or 8% cumulatively this year. So a lot of folks are, you know, obviously cannot afford. Affordability is the huge hanging problem over the housing market at the moment, and so they're moving into the rental market. So the demand for rentals actually remains pretty steady, which is holding those rents up high, continues to hold rents up high.
Is there any knock-on effect at all from the office market or from the commercial real estate market into residential? I mean, I know obviously the properties are built and zoned for very different purposes, but in a lot of places, they're right next door to each other, right? So as we see this tremendous drop in office or commercial real estate asset prices, does that affect at all residential?
Well, we haven't seen any direct impact yet. I mean, what we do hear a lot lately is conversion, possibilities of conversion, and a lot of people are pricing out what that, I'm very sorry. My dog decided that he wants to drop his toys all around me at the moment. There's a lot of consideration of what the possibility, what the likelihood, is it really feasible in many of these buildings, because a lot of them that are, options for conversion, they're really old buildings. There's plumbing issues, there's, a whole list of issues. So we're not yet seeing that play out in terms of home prices.
All right, Selma, thank you so much for joining us. Really appreciate getting a few minutes of your time. Selma Hepp, she's the chief economist.
Much closer to 4 before I would consider it.
Unless you got a massive cash offer.
Yes.
That would
yes.
negate the need for another mortgage.
Well, if I got a massive cash offer, it's not like I could keep that cash, right? I would have to give most of it back to the bank, which currently owns my house.
Exactly.
Yeah. I mean, John, you've probably been in your house for 30 years, right? Do you still have a mortgage?
Close to 30 years. Well, yeah, no, I had to get a mortgage for extenuating circumstances. But yeah, I'm in the house, and the mortgage, never. I kiss it every morning.
Yeah, I'm very happy about that too.
Again, my tolls, my gas, my commuting costs, far more than my monthly mortgage payment.
Well, it's because you live, down the shore, man. We got to get you a
place to be.
Yeah, exactly. All right, with our news in New York City, here's Michael Barr.
Thank you very much, Paul and Matt. It got fiery at last night's Republican primary debate in Miami. During the debate on NBC, billionaire investor Vivek Ramaswamy criticized former South Carolina Governor Nikki Haley for her transition from U.S. ambassador to the United Nations to board member at defense contractor Boeing.
Do you want a leader from a different generation who's going to put this country first? Or do you want Dick Cheney in 3-inch heels?
All right,
Mr. In which case, we've got 2 of them on stage.
Mr. Ramaswamy, thank you. Haley responded.
They're 5-inch heels, and I don't wear them unless you can run in them.
We've got 2 of you on stage.
The second thing that I will say is I wear heels. They're not for a fashion statement. They're for ammunition.
The Republican frontrunner, former President Donald Trump, skipped the debate and held a rally instead in nearby Hialeah. Negotiations are reportedly ongoing about how to bring home the more than 200 hostages still being held by Hamas militants in Gaza. Hamas says it is open to releasing the hostages, but only when a ceasefire in Gaza is implemented. But Israel says it won't agree to a ceasefire until the hostages are released. National Security Council spokesman John Kirby says that the U.S. does not support a ceasefire, but is urging for humanitarian pauses.
A ceasefire, general ceasefire, means everybody lays their arms down and you sort of talk about the end of this conflict. To do that right now would be a benefit to Hamas. It would give them time to resource plan and to execute additional attacks. It would also legitimize what they did on October 7th.
Kirby spoke on ABC's Good Morning America. The 4-month-long Hollywood strike is over. The SAG-AFTRA union reached a tentative deal that includes new protections from artificial intelligence. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. The S&P 500 kind of struggling to keep up its longest winning streak in 2 years. Falling treasury yields, falling oil. They have been pretty potent forces for a risk-on rally, but today both of those are higher. Traders also seem to be on the sidelines up until 2 Eastern time. That's when Fed Chief Jerome Powell delivers his speech. And meantime, the chief economist at Wolfe Research, Stephanie Roth, says, you know what, the Fed is achieving victory.
My highest conviction call is that inflation is going to come down. And there's a couple of factors behind that. Labor supply has been a big driver of lower inflation this year, and that should continue into next year. Female participation is a big driver, and work from home is here to stay. Immigration is another factor there.
And then you have Walt Disney reporting that spike in streaming customers, better than expected earnings. Right now, those shares up 7.3%. Overall, the S&P 500, unchanged, 4383 right now. The Dow is down 18 points. NASDAQ 100, 28 points higher. The 10-year yield 7 basis points higher, 455 there. Strike over, but you know what, ramping up production, that's not going to be quick for Hollywood. Going to take at least 12 weeks to produce new episodes of some of the broadcast shows. And of course, you have the holidays coming up, so that's going to hamper it even further. A number of shows planned for the current season will likely be pushed to next fall. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Matt and Paul.
John Tucker, thank you so much. We appreciate it. Matt Miller, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio. Also streaming live on YouTube, so head over to youtube.com and search Bloomberg Radio. How about that? All right, the market loves AI. The market loves ETFs. So let's create an ETF that focuses on AI, and that's what our next guests are doing, have done, will do. Francis O., APAC CEO and head of AI ETFs for Kraft Technologies, APAC, a lot to go there. Young Chow, Director of AI Business Development and Strategic Partnerships at LG AI Research. A lot of stuff going on here. Gentlemen, thank you for joining us here in our Bloomberg Interactive Broker Studio. What are you guys building here? What are you guys launching? I'll let you guys figure it out.
Right. Thank you. First of all, thank you for let us sharing our stories in here. Yeah. So the Kraft Technologies and AI and LG AI Research, we just launched our latest AI-powered ETF, the ticker LQAI.
LQAI.
Tuesday on the New York Stock Exchange. So this one is special because so far we have in the Kraft, we had the 4 ETFs in NYSE, but this one is first ETF, that co-branded one, together with LG. So we take and leveraging on the LG AI's their own AI model combined with us, so delivering to a new alternative to entering into the U.S. large cap markets.
All right, so Young, what do you guys at LG AI Research, what do you guys do? What do you bring to the table here?
They bring the model.
Exactly.
Good.
Yeah. So we basically power this product. LG AI Research, just to give you a little bit of background, we are institutional fundamental research for LG Group, which is a holdings company for LG Electronics, and we do various different researches in areas such as text, image, vision, all the good stuff. And on the applied AI side, we have what's called a time series forecasting model powered by AI. So we are using this model to basically forecast the future. And that's essentially the engine that powers this ETF.
So what do you put into the model? I mean, first of all, the ETF invests, I'm just looking at the description page here, minimum of 80% of its assets in U.S.-listed large cap companies. So what, like S&P companies?
Yeah, you can consider this large cap universe as around 500 to 700 names, the largest market cap in the U.S. Stock Exchange. And this model is all having the different models to screening out 100 names on a 4-week basis. So by the process of the screening out and the weighting, we are leveraging LGI's technologies.
And then, so Young, what do you put into your model in order to forecast how these companies are going to do?
Yeah, so the data inputs are macro level data, fundamental 10Ks, and also the most recent price data. And we take what's called a multivariate approach when it comes to the modeling. So it's not just a single model. There are multiple models that are specific to a task. So there's a forecasting process, there's a ranking process, there's a selecting process, and a weighting process. And put all those things together, our goal is to find hidden alphas using deep learning models.
Has this been tested?
Yes. So.
And how's the performance been?
So within the group, we move a lot of goods across the sea, and we have used this technology on the supply and demand forecasting side, and have seen a lot of good results on the supply chain management efficiency efforts, and also on the purchasing of raw materials. So LG has a pretty big chemical business. And they also purchase a lot of different raw materials, such as lithium and naphtha. And we saved a lot of money doing this, using this AI-powered forecasting model. And now we're sort of moving into the financial markets, where there's very robust and abundant amount of data that will better sort of optimize our forecasting abilities.
I see. So you developed a model to help LG save money in its business, and then you realized that this model was also applicable to the investment space, and that's where you team up with Kraft, and now you have essentially 100 names, right? But it's an active ETF, so you can move things in and out of the. Right now, I see Netflix is your biggest holding.
Right.
You've got Cencora, McKesson, United Health, Intel, Lilly, Microsoft. These are all your top holdings, and they're big companies, so they're going to be relatively stable, I imagine.
Yes, it is relatively stable, but at the same time enough active, because out of the US large cap universe, we only choosing the 100 names on every 4 weeks basis. So our existing ETF QRFT hold 350 names. This one is a bit more concentrated, 100 names too. So we are expecting the top names will be in and out of the every 4 weeks of time.
So is the LQAI, is the AI ETF, which is different from your large cap ETF, QRFT?
Yes.
So is it focusing on companies that are going to benefit from AI?
No, it's not.
It's using AI to pick stocks.
Exactly.
Boom. Yeah. See, all right, it's all coming to me now.
Yeah.
Okay, so what does the model kind of solve for? Like, what is it? It solves for, what are some of the big variables? Is it sales growth, earnings growth, revenue, valuation?
Exactly. I mean, are you trying to look at companies, like who's going to make the most money? Are you trying to look at companies, which consumers are going to pick this company versus that company? Or are you trying to look at, the stock market is going to rank this company highest? Because obviously, just because a company does well doesn't mean that the stock market is going to agree that it's worth more.
Right.
It's really all weather, right? So this AI agent uses neural network, which works like a human brain, right? So if you think about the traditional quant approach of investing, it's a bit static, right? But on the neural network and deep learning side, the AI model changes in between cycles, right? So we rebalance every 4 weeks, depending on the input data and the training that it goes through. It has the ability to adjust whether that's taking more risk or less risk. We have different scoring system that does that, and depending on the cycle, it'll actively and flexibly adjust to the markets.
So the model is actually, the first step for model is doing is predicting for target price for the next 4 weeks of time in the rebalance movement.
I see.
At the same time, estimating for volatility of the individual stocks, and model will generating the millions of different paths for the next 4 weeks of time. And then there's another agent, AI model is trying to find out of millions of possibilities, what will be the most likely situation at the time of the nowcasting. That we choose the most likely one, and that will be the basis of the portfolio construction of this month.
Every 4 weeks, it rebalances. So is there material change every 4 weeks?
We are expecting, based on the backtest data, we are expecting around 20% plus in and out of the names on every 4 weeks.
Wow.
Fascinating stuff.
It's only been active for 2 days.
I know.
Yes.
So
LQAI.
All right. So we want you to come in maybe 3 to 6 months and tell us how performance has been. That'll be fair.
Yeah, sure.
Young Choi, Director of AI Business Development and Strategic Partnerships at LG AI research. Now I understand what you do. Francis O, APAC CEO and head of AI ETFs at Craft Technology. I understand now what you do. So now we understand how you're all coming together. Let's see if it works. We'll talk to you guys in maybe 3 to 6 months and see how this thing has worked out for you. S&P 500 up 0.1%. We're going to have more coming up. This is Bloomberg. Let's get some company news right now with Denise Pellegrini.
All right, thank you, Paul. And we're keeping an eye on Amazon because it is getting even deeper into the grocery business, and we get more on what's happening there from Bloomberg's Charlie Pellet.
Denise, Amazon is expanding grocery delivery even if you are not an Amazon Prime member. Non-Prime members will be charged about $5 to $14 for each delivery. Members now pay about $7 to $10 with free deliveries for large orders over $100. Amazon is also going to open more of those Amazon Fresh stores around the country as well. Charlie Pellet, Bloomberg Radio.
Yeah, and those Amazon Fresh stores are designed in part to deliver and designed in part for those of us who like to touch what we buy when we eat it. If you're thinking of not getting holiday gifts, some people this year are not doing so. Wallet Hub says more than 1 in 3 Americans plan to skip some gift giving this year because of inflation. One thing people are apparently not skipping, though, is going to theme parks. Disney out with a profit beat thanks in part to strength in theme parks. Disney also talking about cost cutting. That's something that Michael Nathanson, founding partner and senior research analyst at MoffettNathanson, likes.
To me, if you look at Disney's earnings, it's essentially a parks company. I don't want them blowing money on streaming if there's no return on capital. So I'm pretty happy with this outcome because we've been saying forever, like, this is a parks company, and media is becoming less and less important here because it's going down every day in terms of profitability.
And Nathanson with us earlier on Bloomberg Markets. And Sony expected to launch a PlayStation 5 gaming machine tomorrow. That's as it looks to ride sales momentum into the holiday season. And those are some of the company stories we're following this hour. I'm Denise Pellegrini. This is Bloomberg.
Connection lost.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, Matt Miller and Paul Sweeney live here in our Bloomberg Interactive Brokers studio in New York City. S&P 500 up about 1/10%. The Dow's unched and NASDAQ up about 0.3%. Yields a little bit higher here. The 2-year Treasury, let's do the 10-year. The 10-year's up about 7 basis points, 4.54%. WTI crude oil up about 1%, $76 a barrel for WTI crude. And Bitcoin up 2.5%, 36,480. We were above 37,000 earlier, so some big moves up and down for that asset right
37,000?
36,457 to be precise right now. With our news in New York City, here is Michael Barr.
Thank you very much, Paul and Matt. The U.S. said Israel agreed to pause fighting in parts of the northern Gaza Strip for 4 hours each day so people can flee. It's a request that the Biden administration has made for days as the civilian death toll in the war with Hamas keeps rising. It comes as 5 Republican presidential candidates use the third debate of the GOP primary campaign to show their support for Israel. Former New Jersey Governor Chris Christie on NBC.
America is here, no matter what it is you need at any time, to preserve the state of Israel.
Meanwhile, the front runner, Donald Trump, skipped the Miami debate and held a campaign rally about 10 miles away in Hialeah. Hollywood studios and the union representing about 160,000 actors reached a tentative deal to end a strike that shut down TV and film production. Federal authorities say they have busted a high-end brothel network that operated out of the Boston and Washington, D.C. suburbs. Acting U.S. Attorney for Massachusetts, Joshua Levy, spoke at a news conference in Boston about the clientele.
They are doctors, they are lawyers, they're accountants, they're elected officials, they are executives at high-tech companies and pharmaceutical companies, they're military officers, government contractors, professors, scientists. Pick a profession, they're probably represented in this case.
U.S. Attorney Levy says 3 individuals accused of running the sex ring were arrested. The FDA has approved a drug that could be a game changer for weight loss. Zepbound from Eli Lilly works like the injectable weight loss drug Ozempic, mimicking a hormone that makes the body feel full. But Zepbound targets a second hormone, potentially leading to more dramatic weight loss. Dr. Carolina Povian is with the Center for Weight Management at Brigham and Women's Hospital.
We're changing the way medicine is practiced in the United States by treating the obesity with naturally occurring gut hormone therapy that is going to reverse the risk of developing heart disease and diabetes.
Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Paul, Matt?
Hey, Michael Barr, thank you so much. We appreciate it. Matt Miller and Paul Sweeney live here in our Bloomberg Interactive Broker studio. Private credit lenders raised money for $9 trillion energy hold. Brookfield.
That's going to be a big raise.
That's going to be a big raise. And big names in it, too. Brookfield, Blackstone, ECP, they're setting up funds for clean energy. The Inflation Reduction Act is boosting capital for this transition year. So this looks like public-private kind of investments going forward on some of these big eco deals.
It does look like they've identified, well, the global economy is going to need $9.2 trillion of annual investment every year through 2050 to move from fossil fuels to clean energy. This is according to a study by McKinsey. Seems like a very big lift, right? But we've seen raises, for example, from Brookfield. It's raised $6 billion to make infrastructure debt investment. SocGen earlier seeded a fund with Brookfield is going to help make clean energy investments. Blackstone has raised $7.1 billion to focus on clean energy investment. These are obviously just drops in the bucket compared to what's needed, and what's needed isn't necessarily going to be delivered. Right?
No, exactly. So, some of this clean energy stuff, it's kind of replacing ESG in terms of how you're kind of framing some of these things.
They're trying to rebrand that.
I think they're trying to rebrand that as well. So we'll stay on top of that. Big money being spent, public-private. All right. We're going to have more markets coming up for you right now.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Matt Miller here in the Interactive Broker Studio with Bailey Lipschultz. Paul Sweeney has stepped out. He is flying down to Duke in order to, I think he's going to watch a basketball game. Is it season started?
Yeah, started.
Watch a football game. He's got a board meeting. Apparently, he promised me if he sees Tim Cook down there, because I think he's a board member as well, he's going to demand that Apple pay a dividend.
He brings that up
every
time we talk Apple stocks. He's always like, get that dividend number higher.
It's on his list. We are also going to talk to some really interesting guests in this hour. We have Silvio Tavares here. He's the CEO and president of Vantage Score, which is a tool that a lot of consumers are using, probably even more now that rates have risen, to try and get a better rate on a car loan or on a mortgage. And we're also going to talk to Igal Namdar. He's the founder of the Namdar Realty Group. This is a company that owns literally hundreds of malls across the country. They buy pretty much the lowest end properties and then, I guess, kind of milk the tenants and invest nothing in the property until it's literally falling apart, and then they sell it. That's at least how I was explained. I'll ask Igal how he's doing it, because he's also one of the only buyers in office in New York City, along with a few others. And so I think it's a really interesting story, and I think he's made a lot of money in these markets. So that'll be very interesting as well. Right now, I want to get over to Charlie Pellet. He's got your Bloomberg Business Flash. Charlie?
Thank you very much. And here's what's going on, Matt Miller. We have got the S&P on track for 9 in a row. Right now, the S&P is higher by 3 points. That is a gain of just about 0.1%, though. The Dow in the red. Dow Jones Industrial Average, lower little change, down 10 points right now, down less than 0.1%. The Nasdaq Composite Index up 31 points, higher now by 0.2%. 10-year yield, 4.54%, with the 2-year that's yielding 4.96%. Spot gold up $11 the ounce, now at $19.61, gain there of 0.6%. Bitcoin at 36,406. Bitcoin rallying today by 2.3%. West Texas Intermediate crude after yesterday's declines up 0.9% right now, 75.99 a barrel on WTI. The Walt Disney Company is reporting better than expected profits and vowing to cut $2 billion in expenses as it faces renewed pressure from activist investor Nelson Peltz. Disney shares, they are surging by 7.6%. Geetha Raghunathan follows media stocks for Bloomberg Intelligence, and she spoke this morning with our Paul Sweeney on surveillance.
The big thing that really stood out to me and the street was the free cash flow guidance. So they're taking it from close to about $5 billion in fiscal 2023 to almost pre-pandemic levels of $8 billion. That's quite a big jump, and I think that was something that investors were really not expecting. So I think that should really drive kind of a much more, sentiment turnaround. I mean, this is a vote of confidence, I think, in Bob Iger.
And you can hear more of that conversation on the Surveillance podcast. You can download it wherever you get your podcasts. Again, Disney shares now up 7.6%. Also out with earnings last night, Instacart. Instacart shares now trading lower by 9.2%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Charles, thanks very much for that. Charlie Pellet with your Bloomberg Business Flash. Matt Miller here in the Interactive Broker Studio with Bailey Lipschultz. Nora Melinda joins us from Bloomberg News to talk about what's going on in these markets. And Nora, we're up again, but it's not a big move to the upside after we, I think, ended the winning streak yesterday, at least on the S&P. What do you see moving markets today?
Yeah, so looking at a few stocks, as we spoke about Disney, we've got those shares up about the most in a year. The company said that it would cut $2 billion more in expenses and reported better than expected profits. Bob Iger, the CEO, did say that he sees that Disney will be moving from, quote, an era of fixing to a new era of building. We've got media stocks that are also rising in sympathy. And of course, this is also coming after a union that represents actors reached an agreement to end a strike with Hollywood studios.
Yeah, so seeing some gains there, Nora. Just more interested with the House of Mouse. Anything standing out in terms of ESPN or theme parks when you looked at kind of the results and what we're seeing from the company?
Yeah, I mean, I think that that's really interesting. I mean, there's a lot of diversity when it comes to Disney. I mean, obviously people know the name brand from Disney Plus. You've got the media aspect. You've got all these different sectors of the business in particular. But it was really that profit beat that took it through and took it over the edge in regards to how analysts are perceiving the stock.
When's the last time you went to a Disney park?
I haven't. I think I went to one in Florida about 6 or 7 years back, but I haven't been to the one in California. That's where I need to go.
The California's Disneyland, Florida's Disney World.
Right.
And all the options in Florida, though. You've got Animal Kingdom. You've got like 7 parks.
Busch Gardens. Wait, not Disney parks though.
Disney parks, yeah.
Yeah, they have more than just Disney World.
Disney. Well, there's the how like Disney World.
Oh, I see. You're saying like there's
one.
Epcot Center and there's okay. I get it.
You've got all the extensions, but also looking at Affirm Holdings this morning or now in the afternoon. So the shares are rallying after the buy now pay later company posted a first quarter revenue that beat consensus, and that ticker is AFRM. But an analyst from Morgan Stanley did note that the firm is beginning to communicate more clearly with its customers about purchase capacity and is continuing to ramp up its cards. I don't know if you all have ever used buy now pay later, but it does seem that it is pretty popular, especially as a lot of consumers are really feeling the pinch.
I mean, very popular in Europe as well.
Interesting.
Yeah, so it's not just here in the U.S. If that popularity picks up now, I think it might be another warning sign for the economy because you're already seeing consumers put so much of their purchases on credit cards, and if they start doing more buy now, pay later, then that would, I think, be a worry. I see Top Glove in here. What's that? What's the story there?
Yes, don't know if you've been to Top Golf, but that is your high-end golfing spot. It's on track to suffer its worst one-day drop since October of 2020. It reported weaker than expected sales trends, causing 2 Wall Street analysts to downgrade the stock. And they do think, analysts did comment that they do think that Topgolf is undervalued and it doesn't see a near-term catalyst for unlocking that value. So, I thought everyone was out here swinging, but I guess not as much.
They are Callaway brands, so they did rebrand to put Topgolf front and center, and that's been the big focus, booze and swinging golf clubs.
Mm-hmm. Good combo.
WeWork is on your list, but I mean, they're broke.
Does it even count at this point, right?
Well, what are you looking at in terms of WeWork?
So I love WeWork. I think it's a very interesting story, if I do say so myself.
I have to tell you, so 10 years ago, before they had, I think, more than 2 spots, Adam Newman took me over to one of the offices to pitch me on the idea, to do a story on it. And I thought, and still think, it's a great idea. And it was a cool environment. They had a keg of beer there. I'm not sure if the problem was in the idea. It was more, I think, in the execution and the way they went about it.
I mean, they had a lot of hiccups along the way, especially regarding management. But now, the stock it filed for bankruptcy back on Monday, and now it's in over-the-counter trading. But we are seeing quite a bit of traders rallying behind it. Even though we were talking about a penny stock, it was up over $1 yesterday. I know we're talking about small gains, but very interesting. It was up 92% yesterday, but today it's plunging. So we'll just see how the volatility, if it does continue, or if it'll give kind of like a meme stock fashion.
All right, it'll be interesting to see also what else it does to office, which is a great transition to our next guest. Nora, thanks so much for joining us. Nora Melinda there from Bloomberg News talking to us about the stock market. I want to bring in Yigal Namdar. He is the founder of Namdar Realty Group, and if you know of him, it's probably because of his shopping mall purchases. He owns literally hundreds of shopping malls across the country, but more and more I've seen his name in among a very small list of office buyers, especially here in New York City. There's a big concern about the the excess office inventory that we have and the difficulty of repurposing it for anything else. Abigail Doolittle joins us as well, because Abigail, you've been talking to Yigal about this market. Yigal, well, first of all, thanks for coming in. What do you think about this office market? What would lead you to buy here when it seems like, to use a very cliched phrase, it would be an attempt at catching falling knives?
Yeah, well, for the first thing, I'll tell you that as my philosophy into investments, we're like a contrarian investor, and we kind of like always buy when everyone's selling and we sell when everyone's buying. So that's our model. I agree that this is right now there's a lot going on in the office market, and I think that there will be a recovery. I'm not sure exactly if we'll ever go back to pre-COVID occupancies. But my thoughts are, if you can buy prime office buildings, avenue buildings, corner, great light and air, prime submarkets, locations, high quality stuff, maybe A or A minus, there's got to be a flight to quality where a lot of the B, C, and D office buildings will probably have to be repurposed. And so between the contraction of all that office space and being able to, people have to move to different buildings as the rents come down, you start seeing a lot of people shifting from different buildings. Between that and hopefully more people coming back to the office as more big corporations will have their employees come back, we think it will come back. But I think that...
But let me just, to get it straight, are you buying the A minus buildings, or are you looking lower down the ladder in terms of office? And then what are you paying compared to what the prices were pre-pandemic?
So I would say our first entry into office was in 2020. And no, at that point, we were buying an asset that was priced at 800, and we bought it for 400. It was not it was a great location, but as time goes by, we think things have gotten worse since 2020 and 21. And now our focus is more into the better quality assets. And of course, we want to buy it at a steep discount, but you also don't want to buy something that's never going to turn around, because you can get a big discount, and if it's never going to turn around as an office, then no matter what you paid between your carry and the time you have to put in, it won't be worthwhile. So our focus now is the better quality assets, like I said, avenue, corners, and hopefully that's going to rebound.
So your philosophy, you sound a little bit like Warren Buffett when you're saying basically that you like to buy when everybody else is running. He has a pretty famous statement that the time to be greedy is when everybody else is fearful, and be fearful when everybody else is greedy. And when we talked, we said that what you basically just said, that you make your money where you buy it. So how many properties have you bought so far? And in terms of the opportunity ahead, 1.5 trillion of CMBS is coming due by the end of 2025. When you put that together with the fact that here in New York, working from home, the vacancy rates, and then we had a conversation with another office investor a number of weeks ago. We were talking about the value of Third Avenue. He wasn't willing to put a price on it because I didn't think he wanted to sell out his friends so much, but you basically just said that there was a 50% haircut on that building. From a broad perspective, if you had to give, not Class A and trophy, what's the opportunity ahead and for how long, I guess, here in New York?
I think if you take out the A assets and focus on the B and the C's, there will be a tremendous, there has been a big
More
decline.
than 50% down?
Yeah, some assets are down 70%.
That's what I've been hearing on Third Avenue. Somebody was saying that it's like 25 cents on the dollar.
Yeah, Third Avenue corridor, that area, the Midtown has been hit the most. They have a lot of space, and
so are there a lot of other investors like you? I mean, I guess it's probably for the people who have the money and who have the ability to model it out, it's a great opportunity, really.
Yeah,
tough for other people, but
absolutely. I'm not an institution. It's all my own family money, so it's all sweat equity. So I really pay attention, and I analyze deals, and I look at the downside. And I think, like you said, the money is made in real estate on your purchase. And if you can buy good assets at a good discount, and you just have patient capital to wait for market to turn around, and hopefully, I think the rates have a lot to do with it, because once the rates hopefully will go down, then you're going to see the asset values hopefully increasing.
Well, do rates have to go down? Like if we're in a new normal and rates are going to stay where they are and Jay Powell is going to actually stick by higher for longer, at what point does that cause any breakage?
Well, I mean, the rates, my own humble opinion is they would have to go down in the future. It's just, I don't know if they'll be back to zero rates. I think it would be somewhere in between the 5.25 that was raised and what it was before that. But I can't see the rates never going down. I mean, home mortgages where people were paying two somewhat percent, now they're at 7%. How could the average person survive with a 5% increase in their rates? I mean,
well, the 1980s.
Yeah.
Or, 70s and 80s. You know, something that we talked about also is, so you, of course, are known as a big distressed mall investor. Based on some of my work, you're known as one of the 2 big mall distressed investors, and you told me that people know when they have to sell something quickly without due diligence and turn around, that you are known as somebody who can do a cash deal pretty quickly. But you were saying that for some of these properties that don't work out, that you sometimes will then tear the building down and redevelop it, but that right now, because rates are so high, it's really hard to do construction. So what does that piece of your business look like?
So regarding our mall business, I wouldn't say we're focused on distressed malls. I think we're focused on distressed loans, which are over leveraged.
Okay.
Our best purchases are maturity default loans that the assets are on their own doing well, but there's just too much debt on it, and the owner can't refinance unless they put a ton of equity. Therefore, the lenders are taking them back, and they just want it off their books. And again, the opportunity to buy at the right basis, we go in there. So we're focused on having that, and our main focus on our malls is to keep them as malls, because we believe there's a future for brick and mortar. And in some events where obviously some malls do go down, then we look at that as a redevelopment into something else. And in our case, since we have patient capital, if we have to wait a little longer for the rates to go down, or find a right JV partner to come and join us, or potentially sell it to another group, and then we do that.
But you, in malls, at least as far as I've read, you haven't been focused on the higher end properties, right? It seems like you have a slightly different strategy in New York office than you do in your big mall business.
So in the mall business, again, when we started back in 2012, we didn't know much about it. We were buying the C's and the D's, as they categorized it. But I would say in the last 4 or 5 years, our strength is really B market. A malls are just overpriced, and it's just not what we do. But our focus is more towards that B. Maybe it's the best mall in a smaller market. Maybe it's just second mall in town. But we look at their sales and the health ratios of tenants, and we look at occupancy and kind of project out. We want to buy assets that we feel have a long-term potential to stay as a mall.
All right, well, we're going to talk to you on Bloomberg TV in just about an hour's time, so I'm really looking forward to that. Appreciate you coming in, and Abigail Doolittle as well. Abigail Doolittle there, and Yigal Namdar, he's the founder of the Namdar Realty Group, talking to us about New York office. This is Bloomberg. Let's get over to Denise Pellegrini right now. She's got your company news. Denise?
Yeah, one of the things we're watching is Morgan Stanley. It is in the hot seat. We're hearing the Federal Reserve is scrutinizing whether Morgan Stanley's wealth management business is doing enough to prevent potential money laundering, especially when it comes to its overseas clients. And we get more on that from Bloomberg's Tom Busby.
Sources say the New York Fed's top regulator is pressing Morgan Stanley to improve controls and processes. Now, a source also tells us Fed officials have already privately reprimanded Morgan Stanley for not making all of the changes it sought. Representatives for the Fed and the bank declined to comment. The wealth business, key for Morgan Stanley. It's responsible for almost half the company's revenue over the last year. Tom Busby, Bloomberg Radio. All
right, thank you, Tom. And shares of Morgan Stanley, they're down more than 1%. MGM Resorts facing a proposed class action lawsuit stemming from a September hacking. The suit alleges MGM failed to encrypt or adequately protect sensitive information. At least 10 other federal lawsuits have been filed against MGM Resorts as a result of this breach. Another weight loss drug could soon come on the market, talking about a pill from AstraZeneca. It says the experimental obesity pill is potentially cheaper than than current blockbuster shots. The pill form treatment is developed by a Chinese biotech company. It's an early stage clinical test for diabetes right now. Astra has agreed to spend as much as $2 billion for this medicine, so we'll see what comes of that. Shares of Walt Disney significantly higher. The Mouse House reporting better than expected profits and promising to cut $2 billion in expenses. And those are some of the company stories we're following this hour. I'm Denise Pellegrini.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. Stock traders are on hold as Wall Street awaits remarks from Fed Chair Jay Powell. We have got the S&P 500 index in the red right now, giving up earlier gains. Right now, we've got the S&P little changed. It is lower by about half a point. The Dow Jones Industrial Average down 21 now, with a decline there of just about 0.1%, while the NASDAQ Composite Index also higher, a little changed, up less than 0.1%. NASDAQ up now by 3 points. The Russell 2000 Index of small cap shares trading lower, again down another 0.2%. The 10-year yield 4.55%, with a 2-year that's now yielding 4.95%. Spot gold up 0.6%. Gold right now at $19.61 the ounce. Bitcoin right now is up 1.4%, 36,107 on Bitcoin, while West Texas Intermediate crude rallying 1%, bouncing back from yesterday. Now it's $76.11 a barrel. Tesla shares are trading lower as HSBC initiates coverage on the EV maker's stock with a recommendation of reduce, citing the timing of delivery as its primary concern. Tesla shares down now by 5.5%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thanks very much. Charlie Pellet there with your Bloomberg Business Flash. Matt Miller here in the Interactive Broker Studio with Bailey Lipschultz. Paul Sweeney is off to Duke to see his beloved Blue Devils. We are, in a rising rate world. Everything that you buy financed is obviously more expensive. So if you want a car or a house, you all know how high rates have climbed. In that situation, what you want to do is have the best possible credit profile in order to save yourself some money. So I would guess that a lot more people are using VantageScore. It's the product that I use to navigate my home purchase and car purchases as well. We've got the CEO and president here in the studio, Silvio Tavares. Silvio, thanks so much for joining us.
Great to be with you, Matt.
Are you seeing, as you know, as mortgage rates rise to past 7 to 8%, you know, as financing auto loans gets into the double digits, are you seeing just a huge influx in customer interest?
Well, there's absolutely been a very significant growth in the use of VantageScore. In fact, if you look at our latest numbers, we're up 30% on a year-over-year basis. We're one of the 2 national credit scoring companies, and we're used by over 3,000 banks and fintechs, including 9 out of the top 10. And, you know, the thing I tell people is, you got to know your credit score. As you've highlighted, when you're going for a loan, you want to know what your score is so you can get the best possible rate. And if you look over across the country right now, credit scores on average are doing pretty well. Through the end of September, that
was exactly what I was going to ask, because we see, you know, savings have been drawn down. More and more purchases are going on credit cards. As Nora Melinda was just telling us, buy now, pay later is becoming ever more popular. In that environment, when we're worried about the consumer, and I mean, Bailey and I talk about this, you know, all day long, it's interesting to see that credit scores haven't fallen off.
Yeah, well, if you look back and roll back the clock to the start of the year, basically 50% of economists were forecasting that we'd be in a recession right now. It didn't happen. And instead, what we've seen is the average credit score trending very well, 701, as I said. Now, that overall consumer credit health, it masks some concerns underneath. And we're starting to see at that near prime and subprime level some cracks appearing in the edifice. We're watching that very, very carefully because we're monitoring to see if what we're going to see is actually a low-income recession, those people at the lower end of the credit tier experiencing stress.
Well, that's where I wanted to go, because we've seen from earnings from various corporations calling out the strength in the high-income individuals, but saying that their lower-income individuals are not spending like they were, and they're dealing with higher credit tabs. So how does that impact the entire ecosystem?
Well, first of all, it is true. There's definitely a tale of two cities that's emerging. The high end continuing to do well, lower income consumers being increasingly challenged. Because if you look at the math, it's very simple. If you have a credit card balance right now and the interest rate goes up, even though you maintain that exact same credit card balance, your monthly payment is going to go up, all right? And so that's the dynamic, and the folks that are most exposed to that are at the lower end. As we look forward into 2024, I think that's going to be an increasing challenge. That same segment is going to experience not just higher monthly payments, but new obligations like student loans. We published an analysis around this, and we anticipate that a large proportion of consumers at that low end are going to have challenges paying back that loan. The good news now is you can actually prepare for that. You've got about a year to prepare for that, and if you start repaying, you're actually going to see your credit score go up. So that's the silver lining.
Well, as someone who recently bought a house, I have to mention that every time I come on, with
Congrats.
an interest rate
Congratulations,
that
yeah.
jump between offer and acceptance, how does a higher interest rate environment actually impact borrowers, and how does that impact the entire ecosystem, not just buying a house or a car with those bigger purchases, but as you mentioned, if I'm loading up on Airbnb orders and Uber orders and not paying off my credit card, how does that impact everything?
Well, we call that credit card utilization rate and credit utilization rate. And overall, consumers have actually had a lot of good self-discipline. If you look at overall credit utilization from August to September, it actually moderated, went down by about 0.1%. If you look at credit card and credit utilization on a year-over-year basis, it's also declined by about 0.3%. So the story there is consumers are being quite self-disciplined. They're aware of the risks in the environment. We got 2 big wars going on around the world, and interest rates are going up, and overall consumers are actually managing their credit pretty well. The concern is, if we look forward, how does that play out? And so we publish a monthly credit gauge which shows consumer credit health. We call that VantageScore credit gauge, and it looks like through the end of the month consumers are maintaining that discipline as they enter the almighty holiday spending season.
So VantageScore, you know, as I said, I used it and have for a long time because you partner with my bank, Huntington Bank, in the great state of Ohio. How about lenders? Are they using your services as well?
So we're seeing a very significant increase in the use by lenders because they want to use the most predictive score. We had a big win late last year. The FHFA, which is the main regulator for mortgages, actually mandated the use of VantageScore for all mortgages issued by Fannie Mae and Freddie Mac. Get this, Matt, we expect $1 trillion in new mortgages to be made available to people that were in fact creditworthy but didn't have a credit score before. We think that's a big, big win for the economy at a time where we need some good news, right? And so we're anticipating that kicking in the third quarter of 2024. A lot more people being able to qualify for their first mortgage. We think that's good all around, creates more wealth and creates a good momentum for the economy as well. We know 2024 is going to be more challenging than 2023.
All right. Silvio, thanks so much for coming in. Always appreciate talking with you. Silvio Tavares is the CEO and president of VantageScore, talking to us about this high-rate market that we're in and how difficult it is for new home buyers like Bailey Lipschultz to make a purchase. This is your first mortgage?
First mortgage, first home purchase. First time.
Did you go the full 30-year hog, or did you do an adjustable rate hoping for cuts down the line?
30-year, locked it in, and hopefully we'll refinance.
Yeah, refinance.
Optimism. Cautious optimism.
Refinance. Get your credit score up. Keep working with VantageScore until you have the ability to refinance at a much lower rate. All right, I want to shift gears now and focus on Airbnb. The CEO, Brian Chesky, has sold shares for $3.5 million, and he's also pushing more features on his app to try and get you to use his services. Let's listen to an interview with Brian Chesky now.
We welcome our Bloomberg Radio listeners and TV audience worldwide. Airbnb is unveiling new features and AI-powered tools for its app in a push to increase reliability. As part of the new features, listings rated above 4.9 stars with less than 1% cancellations from hosts will get a new guest favorite label. 2 million out of the more than 7 million homes on the Airbnb platform qualify for that label. Let's bring in Airbnb CEO Brian Chesky and our very own Emily Chang. Take it away, Em.
Thank you, Ed, and thank you, Brian, as always, for joining us. Look, we can count on you now to sort of up the ante with these new product features a couple of times a year, and as a guest, I'm excited about guest favorites. But at the end of the day, it's about driving new business. How many new additional bookings do you think these new features can unlock?
I mean, I think this is going to be a really big growth driver for us, Emily. And the reason why is the number one reason people like Airbnb is because the homes are unique. Every home is different. The biggest problem with Airbnb, and the number one reason people book hotels, is you know what you're going to get. And we asked, what if we can combine the best of both? What if you can have the uniqueness of Airbnb with the reliability you expect from a hotel? And that's what guest favorites are. But it's not our word. It's our guest word, because we took 370 million reviews and millions of customer service contacts, and we created this collection of 2 million homes. I think this is going to bring a whole new audience to Airbnb.
There was a lot of focus on your outlook last week when you reported results. You talked about macroeconomic trends. You said there's volatility. You said bookings could moderate, and that you're already seeing signs from that in this quarter. Can you tell us a little more about this volatility? Where is it coming from? How dramatic is it? And how big is the impact going to be?
Well, mostly what we were doing is we were just a few weeks into the quarter, and we were seeing a lot of geopolitical uncertainty, so we just wanted to be cautious. At the same time, we feel like our business is extremely resilient. We've done $4.2 billion in free cash flow this year, trailing 12 months. That is a 44% free cash flow margin. Our revenue grew at 18% year over year. So we're feeling really good at this very moment. We just wanted to exercise a little bit of caution, just given what was happening in the world.
So you've said Airbnb is now ready to expand beyond its core. Can you give us a tease? Where is that next level of growth and monetization going to come from?
I think it's a few areas. I mean, let me first say, I think we've only scratched the surface of how big our core business of booking homes around the world could be. Next is international. You know, we're in 220 countries and regions around the world, one of the most global internet companies. And yet a lot of our business is still concentrated in the United States and a few other English-speaking countries. So whether it's Germany, Korea, Japan, Brazil, or many other countries, these are huge markets that we can grow. And that's going to create a huge amount of growth. And by the way, if there's ever a company that would be able to expand internationally, it would be a global travel network. And then beyond that, I think Airbnb can do much more than offer homes for people to book on a nightly basis. And I hope to be back on your show soon to be able to tell you about some of those things.
to our Bloomberg Radio and TV audience worldwide. We are speaking to Airbnb CEO Brian Chesky. Em mentioned it at the beginning, these kind of regular annual updates. And I know you yourself are actually pretty hands-on product-wise. But it's all done internally. And I think about the investments that you've had to make to do the AI integration into this latest tool. Where are you spending? Is it just purely on talent?
Where am I spending my time or our money or both?
Time and money. Time is money.
I'm spending most of my time on the product. What I've spent most of my time in the last 2 years, let me back up. Travel is one of the most aspirational things in the world, right? If you ask people, all the money in the world, what would you do? They say they travel. And yet the way a lot of travel companies are run, they're run by just looking at the financials and look at the metrics. And we do that, but there's something deeper. You have to create an amazing experience for guests and hosts. And so what I've done is I've been listening over the last couple of years, and we made 350 major features and upgrades based on what the community's told us. We said that yesterday was a turning point, that when we could have a major answer for reliability, the #1 reason people book hotels, now we have permission to do new things. Because people don't want new things from you unless they love the thing you do. I think people are gonna love guest favorites, and I think we're gonna be ready for us to see new things, and that's what I'm spending my time on. My time is spent on innovation and what's next for Airbnb.
And perhaps sometimes having to go and talk to regulators. And I think of some of the reasons people are buying hotels in New York is because there's less Airbnb supply. Yes. You called it basically a de facto ban here in New York. How is that going? What are you doing to try and push back?
Well, it means, the way it's going is that hotels are now up 8% year over year from a cost perspective. If you have me on here next year, I'm gonna make a prediction, hotels will be more expensive. I'm not sure if housing will be down. So New York, I think, is turning into at least a cautionary tale. I'm disappointed of how it could go. But you know what? Other cities have chosen a different approach. We're 100,000 cities. In our top 200 markets, 80% of them have sensible regulation on the books. So we found a sensible solution. And whether it's London or Paris, in Paris, 500,000 people are gonna stay in Airbnbs for the Olympics. So I want cities to know that we wanna be part of the solution, not part of the problem, and we're willing to compromise and come to the table and find ways to make the cities work, and I think a lot of other cities have found that path.
Brian, you know, obviously what's going on in New York has been pretty dramatic. You know, people are calling this the Airbnb apocalypse, and there are a lot of concerns that other cities could follow on, even if they do have smart regulation. Now, I'm sort of curious on top of that, what are the travel trends that you're seeing post-pandemic? Are people wanting to say, you know, I'm tired, I just want a staycation? And, you know, what changes are you seeing in travel trends for the folks who are going out?
So 2 things. Just on the first part of the question, we do not think New York is a trend. We think New York's late to the party, not early. I mean, again, we've worked with cities around the world. We now collect $9 billion of hotel tax, and I think that cities are not looking to New York. On the travel trends, it's really interesting, Emily. Before the pandemic, 80% of our business was people either crossing a border or going into a city. The pandemic, that was shut off. So what were people doing? They were getting in a car, and they were staying in big homes, larger homes with their friends, their family, typically in less urban areas. So what's happening now? What's interesting is the old Airbnb is back, the old ways of traveling are back, but the new ways of traveling are here to stay. And there's 2 reasons why. Number 1, even though some people are going back to the office more often, there's a lot of flexibility. You can now do more work from an extended weekend. I'll make a prediction. Next week for Thanksgiving, or the week after for Thanksgiving, a lot of people aren't taking 3 or 5 day weeks, they're taking 7-day weeks. They're gonna work remotely Monday or Tuesday. So they're gonna start taking those longer trips. So it's actually a very resilient business, and I think that more people are gonna travel because it's what was taken away from the pandemic, and I think it's how they wanna spend time with people.
I want that 7-day week, Brian. Last quick question. We've only got 30 seconds left. Affordability. You're bringing down cleaning fees. Prices have come down a bit, but do they need to come down more? And can you do that without alienating hosts?
Yeah, I think our secret sauce is finding this magic balance to make sure that on the one hand, the offering is affordable for guests. On the other hand, hosts are still making great money putting on Airbnb. We don't price anything. So what we're doing is we're just trying to provide transparency and tools and guidelines. Here's the good news. In the United States, prices are 3% down on Airbnb year over year, yet host earnings are at record highs, while hotels are up 10%. So the trend line's going in the right place, and I think hopefully a year from now, our prices won't be going up nearly as fast as hotels, and if that happens, it means Airbnb is a better value every year than the year before.
Something's deflationary. Airbnb CEO Brian Chesky, we thank you so much for your time. Bloomberg's Emily Chang as well. We love having you on. Thank you.
All right, that was Brian Chesky, the CEO of Airbnb, talking to our extended Bloomberg Technology team there about, the stock hasn't done horribly compared to a lot of the companies that went public in 2020 and 2021. It's at $118. It had hit a high of $218, not even $216.84. So it hasn't gotten punished as much as a lot of those other, one-time high flyers like Rivian, for example.
Affirm. You look at a company that's down 85% still from its peak. At least Airbnb benefited from the COVID pandemic and has been able to still hang in there, still below its IPO price, but not terrible.
Let's get over to Charlie Pellet right now. He's got you a Bloomberg Business Flash. Charlie?
Thank you very much. And here's what's going on. We have got U.S. stocks right now. We are trading mixed. The Dow Jones Industrial Average, as we await Fed Chair Jay Powell, we have got the Dow Jones Industrial Average down 29, drop there of 0.1%. S&P slipping into the red. It is down by 1 point right now. The NASDAQ Composite Index lower by 5, drop there of less than 0.1%. So the Dow, the S&P, NASDAQ, they are all in the red right now. NVIDIA shares up by 13%, according to a report from a state-affiliated news outlet China Star Market. NVIDIA will release 3 new artificial intelligence chips for China. Right now, again, we have got the Dow, the S&P, NASDAQ all in the red, with the S&P 500 index lower now by 2 points, down less than 0.1%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Charlie, thanks very much. Matt Miller here with Bailey Lipschultz in the Bloomberg Interactive Brokers studio. It's interesting, Bailey, we had a string of gains, 7 days in a row, right, of gains on the S&P 500.
We were at 8. We were 0.1% higher yesterday.
We were, yeah, but we didn't close
No, yeah, we did.
Yeah. Oh, yesterday?
Yesterday we were higher, yeah. Today was testing the longest winning streak in 2 decades. We closed just a touch higher.
Wow.
Yeah.
You know what? When I left, we were down, and I didn't think we were going to pull that swing off.
Well, the interesting thing is,
imagine if we swung higher today.
Well, we're talking points, but NASDAQ 100 on pace for a 10th straight day. Only the longest winning streak since 2021, but still.
Yeah, both, right, are the longest in 2 years. S&P as well.
S&P would be in 2 decades if it closed green today.
If it closes green today, we'll have the longest winning streak in 2 decades. That is the kind of superlative that we pay you for, Bailey Lipschultz. That's pretty amazing. Is it just the drop in rates that's driving this? Is it the earnings picture? What is it?
I think we're just waiting for Powell. I mean, are you saying why we're higher today? Or
No. Over the last 2 weeks. I mean, it's because I guess we've come back from over 5% across the curve now to more normal kind of feeling 4.5.
And you had last week where Powell was basically like, hey, we're going to hang out where we're at. And then jobs data came in on Friday and basically solidified the expectations that yields are probably going to go down.
All right. Very interesting stuff. We are also going to hear from the CEO of ARM Holdings talking to the Bloomberg Tech team. Let's go to the TV studio right now.
Welcome to our TV and radio audiences worldwide. Chip design firm ARM out with earnings for the first time since it returned as a public company. That was back in September. It beat expectations for revenue and adjusted earnings per share in the second quarter. Shares, as you'll see, under pressure at the moment. This is more about the outlook for the company. Best person to speak to about it, the ARM CEO, Renee Haas. It is great to have some time with you. And look, you're back trading it kind of where you priced on the IPO at the moment. I'm looking at a 51.20 at the moment. Tell us a little bit about the ongoing weakness in the industry when it comes to mobile, because you've been diversifying, but why is that not bearing fruit in the here and the now?
Yeah, thank you, Caroline. We had a record revenue quarter, which we are thrilled about. ARM has never done $800 million in a quarter. And we also raised our yearly guidance. So we're very, very confident about the outlook going forward. The stock's a little noisy, I think, based upon timings and things of that nature. But, generally speaking, what we're seeing is our royalty business has increased 3 quarters in a row. And what we're hearing from our partners that we're in the trough in terms of the overall inventory and getting better. And our licensing business is really strong. So as a result, great quarter, and we have raised our yearly guidance.
Okay, the context there is clear, and I'm interested about perhaps the AI focus that you've been having. There's been licenses for potentially a bit lumpy at the moment when it comes to companies wanting to deploy your technology within their AI offerings. I'm interested in when that becomes big volumes. When does that become more dependable rising royalties, do you think?
Yeah, so I think one of the things we saw this last quarter in terms of our increased licensing activity was companies looking to invest more to address this demand for AI and AI everywhere. I think the general perspective was that you need more and more compute technology. What exists in systems today is not good enough. More is needed. So I think across all markets, we're going to see AI find its way into the end product. So for us, 70% of the world's population uses ARM. It's literally impossible to do an AI application without us. And we think over the next several years, it's going to drive great growth for us.
And for that, R&D is needed. And I go back to the fact that you sort of said there's noise around the share price. That's kind of the conundrum of being a public company, is the fact that you are a business that needs to spend internally, you need to innovate, you need to invest, but you've now got these short-term goals that in public investors want to see in terms of revenue build, in terms of profitability. How are you finding that tension as a publicly traded company with ultimately a more demanding public investor base?
Yeah, and as mentioned again, we had record revenue in the quarter. Our licensing business was up over 100%. So what that says is companies are increasingly spending money on developing products that have ARM inside. And based upon that and the royalty outlook improving for the year, we did raise our guidance annually. So as I mentioned, we're very, very confident about the year ahead. As far as the balance between R&D and meeting goals and things of that nature, yeah, it's something every public company CEO or even private company CEO has to consider. So I don't think we're in any different bucket there.
Welcome to our Bloomberg Radio and television audience worldwide. Speaking to ARM CEO Rene Haas. Yes, the eagle-eyed out there would notice, Rene, there's a discrepancy, right, between the cautious outlook for the current period and then this kind of full fiscal year boost you had relative to the kind of guidance during the IPO roadshow. What accounts for that discrepancy? Why short-term worry, but kind of confidence that longer term you're going to start booking, particularly on the licensing side?
Yeah, so we've just returned to the public markets, and I think we've got some time to help teach the outer community about how our business works. Our licensing business is both a combination of timing and ratable revenue in terms of when we can actually recognize the revenue. We have great visibility into deals. We have great visibility in terms of revenue profile, which is why, again, we're very, very confident in the year. So inside the quarter, our licensing tends to be lumpy. Yes. Something might happen one month versus the next. But in the main, we're very, very confident and have great outlook in terms of when and if those deals will close.
Rene, ARM is still mostly a smartphone story, highly cyclical, low-margin market. You made gains in data center and auto. Can you tell us when ARM will stop being mostly a smartphone story?
I think I can tell you that today in terms of mostly. We were probably 60% of our revenues prior to the acquisition, maybe more, were tied to smartphones. Today, it's less than half. So we are not mostly a smartphone company anymore. Our royalty revenues in the last quarter were up 20% in cloud and 20% up in automotive. So we have greatly, greatly diversified. And that's really a combination of both a very, very focused strategy to do so and the pull and demand for ARM technology driven by power efficiency. These megawatt data centers cannot afford to add more and more energy. At the same time, your automobile running off a battery, it's a computer on wheels, needs to be very, very efficient as well. So the trends are in our favor, and we've also made the investment in the specific products. So as a result, we're seeing very, very strong growth across these other businesses. And I think you can say that today, we're not a smartphone company.
30 seconds left, Rene, which is always a joy for a CEO to hear. But I'm interested in London listing anytime soon?
London listing anytime soon. Nothing that I can talk about specifically today. It's something we're considering down the road, but nothing specific I can tell you today.
ARM CEO Rene Haas, thank you for joining us.
Thank you so much.
And Bloomberg Markets continues. Rene Haas, the CEO of ARM, and shares of ARM trading lower today. They're down by 5.6%. The Dow lower, S&P, NASDAQ, they are both advancing. Bloomberg Markets continues. Charlie Pellet along with Bailey Lipschultz. And we are here now with John Cooper, who is the CEO and founder of Overalls, which describes itself as a, quote, modern benefits company. They are based here in New York. John Cooper, welcome to Bloomberg Markets. Good to have you with us. Tell me a little bit more about your company. How long has Overalls been around? And if you are in the business of benefits and insurance, how did you come up with the name Overalls?
It's my favorite question. Someone once asked me, how do we come up with the name underwear? And I had to correct them. Good to be on the show. So a bit about us. After I sold my last company, partnered up with a venture capital fund, and we had ideas around employee benefits. It was part of the pandemic. Everything had changed in terms of the ways people worked. I remember we had all these different ideas that we were evaluating and weighing. And in the middle of one of these brainstorm sessions, my son burst through the door. He's like, Dad, you need to come to the basement. Our basement's flooded. And sure enough, our basement is flooded. That was hours of missed work where I was dealing with the flood and insurance and all that. A week later, one of my co-founders has his car stolen. Hours of work. And I remember we had this aha moment. We're looking at each other like, there's all these benefits out there. And yet these problems that we both have experienced are so universal. Every employee at every company has these types of moments that happen, whether it's a broken pipe, stolen car, an insurance issue, a parent that gets sick, and it's super stressful. It makes us way less productive, and there's no employee benefit to help people deal with these things. And that really became the birth of Overall. So that's what we are. We are a concierge-like benefit that employers offer to their employees. And the whole purpose is to help people save time, money, and stress from the day-to-day life hassles.
And John, business question here. How do you guys make money? Are you courting companies and the companies are paying you guys? Do you get a share out of each service that gets rendered?
So we are paid a subscription by employers. The way they look at this is, across their benefits budget, they're always looking with what can we offer our employees that will help drive employee retention, employee engagement, and employee productivity. So they're paying us a subscription for the service. And that's our sole source of revenue. And we love that because it keeps us highly aligned with our clients.
What was the bigger hassle, by the way, in dealing with that flooded basement? Dealing with the insurance companies or dealing with the contractors?
Oh, gosh, I'm having flashbacks. It's all frustrating. And, I spent my life in the insurance industry, so it's as frustrating as it is for me. For your average worker, that's way more frustrating, way more time consuming. And I'll tell you one of the things that was the biggest surprise to me. When we first started this, we thought it was going to be professional services business, white collar businesses. One of our first really large clients was a call center. And we started seeing a lot of manufacturing companies sign up. And what we've come to realize, and it makes perfect sense in hindsight, but what we've come to realize is these same sort of frustrations that for us are annoying and time consuming, for a frontline worker who's hourly, that's the difference between whether they're going to turn up to work that day, whether they'll be able to get there, get paid, or whether they'll have to call out sick and that company has to pay someone else time and a half. That employee doesn't get paid. So they're frustrating, but they also have a very real impact on businesses' productivity and their costs.
Now, John, that was where I was going to go with my next question. Where are you seeing the most traction with clients and companies that are using you as a service, just because this sounds like a novel concept that would be targeted towards younger workers, people who are working from home, but you're pointing out that maybe that's not necessarily the case?
Yeah, I mean, what we've seen, knock on wood, is very broad demand. We have seen three drivers really emerge. One would be this whole work from home and return to office movement. We're seeing a lot of companies are thinking about, how do I bring people back into the office? I know that's going to be tough. I know that's going to be frustrating. You just gotten used to working from home. What can we do to make that transition easier, to be supportive, and to be helpful during that process? So that's one. Another that we've seen has really been around companies focused on productivity. According to the Department of Labor, Q4 of 2022 was the lowest level of productivity since they started measuring it, of workforce productivity. So companies are saying, what benefits can I offer that will address my employees' concerns around stress and burnout, but not at the expense of productivity? So I think of like a 4-day work week. That's really trendy. People talk about that now. maybe you help with stress, maybe you help with burnout, but on the productivity side, that's a pretty tough argument to make. What we're able to do is we're able to show that 17% of time that people spend in the office at work, they're actually dealing with non-work stuff. They're dealing with issues at home, issues with caregiving, children, and so on. So it's really our ROI is about reclaiming that time. So that's the second theme is productivity. And then the third is all about stress and burnout. Companies look at what practical things can I do to help my employees who are more stressed now than ever really get a hold of that stress and give them some extra support.
John, I've only got about 30 seconds here, but the big picture, just in terms of the entire return to the office debate, where do we stand right now? Are people coming back to the office? Do employers have the upper hand when it comes now to getting people back in the office?
It's a great question, and it's such a topical one. What we've seen is that 95% of companies with over 100 employees plan to bring people back into the office in 2024. And, maybe different flavors of it. It may be 2 or 3 days a week. It may be 5 days a week. But companies want people back in the office. And on the flip side, that 65% of employees saying, I would rather work from home. So it's definitely at the height of HR issues, board issues, CEO issues that they're dealing with right now is what's the right balance.
All right, John Cooper, I want to thank you so much for spending time with us today on Bloomberg Markets. John Cooper, CEO, founder of Overalls, which is a modern benefits company. I'm Charlie Pellet along with Bailey Lipschultz, and it is time now to get a news update. Let us head down to Washington, D.C. and the 99.1 newsroom. Here she is, Nancy Lyons.
Thanks, Charlie. Israel is agreeing to 4-hour daily humanitarian pauses in fighting in northern Gaza. That's to allow citizens to flee. U.S. National Security Council spokesman John Kirby.
We've been told by the Israelis that there will be no military operations in these areas over the duration of the pause, and that this process is starting today.
Kirby says the Israelis have committed to announcing each 4-hour window at least 3 hours in advance. The top Democrat in the House is warning of a possible government shutdown next week. House Minority Leader Hakeem Jeffries called on Republicans to work with Democrats to keep the government open beyond the November 17th deadline. He says if that doesn't happen,
the only approach is to pass a continuing resolution at the fiscal year 2023 levels. Period. Full stop.
Jeffrey says Democrats in the House will not pay a single, as he calls it, right-wing ransom demand from Republicans. Speaker Mike Johnson has yet to roll out a plan to fund the government since securing the Speaker's gavel last month. Hollywood studios and the union representing some 160,000 actors have reached an agreement to end a strike that shut down TV and film production for 118 days. It includes unprecedented restrictions on the use of artificial intelligence to recreate an actor's likeness, as well as bonus payments from streaming services. Duncan Crabtree Ireland is the executive director and chief negotiator for SAG-AFTRA.
I think our members, as we are able to release more of the details of it, will look at them and say, this is something that was worth being on strike for, and our union has helped protect our future.
Duncan Crabtree Ireland, SAG-AFTRA's national board, will review the deal November 10th. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. Now back to you, Charlie and Bailey.
All right. We thank you very much, Nancy Lyons, in the 99.1 newsroom in Washington, D.C. And we are looking at a number of stories here in Bloomberg. Yes, we always follow the economy, but we've got a news story that says that the U.S. is scoring below average on an index that measures the well-being of the nation. The index is a project of the American Academy of Arts and Sciences, and it seeks to go beyond traditional economic indicators to assess how households are really doing and their outlook in life. Bailey Lipschultz, have you had a chance to look at the story, and what are some of the key takeaways?
I'm looking at it right now, Charlie. It is fascinating to me that the U.S. well-being score on a scale of 10 in 2021 was 4.91. That feels like, I remember being in college that a 7 out of 10 is a C, but a 4.9 out of 10 is
well below failure.
Well below failing. And the index uses data from 2005 to 2021. The interesting thing looking through the article is that it doesn't capture the surge in consumer prices or the higher interest rate hikes. So Charlie, when you think about it, a lot has happened in 2 years. And we've seen consumers be resilient, but I'm paying, the interest rate on my house is far higher than I would have imagined. And inflation has only taken things like fast food and made it more like eating out.
Well, let's take a look at some of the reasons then for that 4.91 scale. And as you point out, that's well below F, but it does reflect poor levels of economic opportunities, household financial resilience, and the numbers all come from Census Bureau surveys along with the National Center for Health Statistics. And again, it does use data from 2005 to 2021. And as you point out, Bailey, that leaves out a lot of stuff.
A lot of things, and you're looking through the different proposals and ways to try to amend some of the issues. Again, when you're a country like the U.S., you don't want to score well below average. One thing that is interesting is to let states, tribes, or municipalities sponsor immigrants via a community partnership visas. According to the data, immigrants spend an estimated $1.3 trillion annually and contribute $492 billion in local taxes.
All right. Again, Bailey Lipschultz, the headline on the story, the U.S. economy scores low on a new index measuring America's well-being. Stock market's well-being right now, we're in the green. S&P 500 index higher by 3 points right now. The Dow is trading lower. NASDAQ is higher by 16. We got Sound On with Joe Matthew coming up next. And this is Bloomberg.
From our nation's capital, this is Bloomberg Sound On.
Two major stories that we're following here developing before our eyes.
What does it say about Trump's influence on the Republican Party?
What can the Biden administration do on its own to support Israel?
Bloomberg Sound On. Politics, policy, and perspective from D.C.'s top names.
The Republican caucus is at war with itself. Members of Congress would have a press conference every day if somebody would cover that.
There is bipartisan support for Israel.
This is one of the big ones we only see once every decade or 2 decades in the Middle East.
Bloomberg Sound On with Joe Matthew on Bloomberg Radio.
The Republican candidates for president finally turned their fire on Donald Trump. Welcome to the fastest show in politics. As the race for second reaches a new level, just a day after Republicans were thumped in state elections, we're going to talk through it with Larry Sabato, of course, at the University of Virginia's Center for Politics, the namesake of Sabato's crystal ball. With 8 days now to a government shutdown and no plan in place to avoid one, we'll talk about all of this with our signature panel. Bloomberg Politics contributors Rick Davis and Jeannie Shanzano are with us for the hour. So let's get things rolling, as always, with a look at Wall Street. An update on trading now in New York with Charlie Pelley.
Right, I thank you very much. And here's what's going on. Joe Matthew, we've got the Dow lower. The S&P, NASDAQ, they are in the green. Little change, though. That is your key takeaway, and I'll tell you why. Because we are just under an hour from remarks from Fed Chair Jay Powell. He'll be speaking at 2 o'clock Wall Street time at the IMF's annual research conference. And yes, we will have those remarks for you live right here on Bloomberg Radio. And those comments will come amid questions about whether the Federal Reserve is done raising rates. George Borey is Chief Investment Strategist for Fixed Income at Allspring Global Investments.
The need to do so, to move, is really non-existent right now. But what Powell and the team are doing is they're playing a sort of a mind game, if you will, with the market. They need the market to believe that they will move if they need to. But in reality, the data is telling us that they can sit pat for the foreseeable future.
And right now we do have the Dow Jones Industrial Average down 50, drop there of 0.1%. S&P lower by 6, a decline of 0.1%. NASDAQ now down 21, drop there of just about 0.2%. 10-year at 4.61% with a 2-year 4.98%. Gold up $10 the ounce to $19.60, up by about 0.5%. And West Texas Intermediate crude pushing higher by 1.1%, $76.15 a barrel. The Disney company, its earnings, certainly the big story today. A member of the Dow, Disney gaining by the most in a year after reporting better than expected profits and vowing to cut $2 billion in expenses as it faces pressure from activist investor Nelson Peltz. And right now we do have shares of the Walt Disney Company on a down day for the rest of the market. Disney up now by 7.3%. So again, recapping, red on the screen now across the board. The Dow, the S&P, NASDAQ all lower. S&P down 12, drop there of 0.3%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, we thank you and welcome to the Thursday edition of Bloomberg Sound On. Little Friday, I'm Joe Matthew in Washington. Folks a bit bleary-eyed here at lunch today after a late night watching the debate. We'll get to the shutdown politics, of course, this hour. But it was only the third round here. And following the elections that we saw this week in Ohio, in Virginia, in Kentucky, we were paying extra close attention to the Republican debate last evening in Miami. The big question, of course, who won? But you know it's more nuanced than that, as we'll discuss with Larry Sabato in just a moment. Ron DeSantis, though, at center stage, and the others. Of course, you knew about Chris Christie already, coming out swinging in many cases against the former president. And based on some of the recent polling data we've seen, maybe it's no wonder why. Here's the governor of Florida.
Donald Trump's a lot different guy than he was in 2016. He owes it to you to be on this stage and explain why he should get another chance. He should explain why he didn't have Mexico pay for the border wall. He should explain why he racked up so much debt. He should explain why he didn't drain the swamp. And he said Republicans were going to get tired of winning. Well, we saw last night, I'm sick of Republicans losing.
But it doesn't seem to matter, at least when you look at presidential polls, whether they be national or, frankly, in the swing states. Donald Trump has a 30-some point lead over Ron DeSantis and the rest of the field. This is where we begin with Larry Sabato, the director of the University of Virginia Center for Politics, with us here on this day after. What else could we ask for, Larry? It's great to have you back on Bloomberg. I won't ask you who won last night, but I'll start by asking you about Donald Trump, the guy who was not in the room. Has this been a winning strategy to keep boycotting these debates?
Well, if you'd asked me who won, of course I would have said Donald Trump. He's won all the debates because he hasn't been there. If, in fact, he ends up to be the nominee, and right now everybody thinks that he will, if he does, the smartest decision he would have made, other than the decisions that led to the various trials, but the smartest decision that he has made is not participating in the debates. All he would have done would have been to elevate these challengers. They would have had him right there. Inevitably, they would have gotten him deeply angry and going cray-cray and screaming, and it would have been the Donald Trump that would not have sold even in this particular year or next year. But he's not there. And so they're shadow boxing. And I don't want to demean them, because actually I think four of the five are quite good and would make, if you're going to have a Republican president, they would make a decent president. I know they would basically obey the Constitution. That'd be my guess. But they don't have that ability or they're not going to have that ability in all probability, because Donald Trump isn't there, and they are the kids' table, as everyone has said. They're the kids' table at Thanksgiving. It's not fair. It's not right. They deserve better, but that's the way it is.
The way it is. And the moderators have their own approach here, I'm not here to analyze or criticize the moderators, but there were a lot of questions, Larry, about why the issue of abortion was relegated to the back 30 minutes of a 2-hour debate. It took them 90 minutes to get to the issue that really seemed to dominate the elections the night before. A lot of folks in advance were looking specifically at Nikki Haley to see if she could make some headway on this issue. And here's how she put it last night.
As much as I'm pro-life, I don't judge anyone for being pro-choice, and I don't want them to judge me for being pro-life. So when we're looking at this, there are some states that are going more on the pro-life side. I welcome that. There's some states that are going more on the pro-choice side. I wish that wasn't the case, but the people decided. But when it comes to the federal law, which is what's being debated here, be honest, it's going to take 60 Senate votes, a majority of the House, and a president to sign it.
A reality check and another outreach to those who may not agree with her on this. Larry, was that the winning message for Republicans on that singular issue of abortion?
Well, it's a better message than the ones they've been using for the most part, because it's not selling. You know, after a while, as the old saying goes, if you spend a fortune on the dog food and the label looks great and the dogs never eat it, it's probably because the dog food isn't very good, and the dogs are the ones that get to determine what the masters buy. So her answer was perfectly reasonable from a political sense. And by the way, she's absolutely right. If you don't get 60 votes in the Senate, this is all just kabuki theater. It's just play acting. And that's what politicians do a lot. But I agree with you. We didn't get to some of the substantive questions until later. And I also think they should have asked a lot more about Donald Trump. They could have gotten into the particulars and let them react to it. But, you know, as you say, it's easy to criticize moderators. I've done debates myself, and it's horrible. I have nothing but sympathy for the moderators.
Yeah, it's not a fun job. You mentioned 4 of 5. I think I know that fifth you're referring to. Vivek Ramaswamy had a lot of one-liners last night.
Did I mention any names? Did I mention any names?
Well, I'm just going to let you disagree with me, Larry. I will just move ahead with the strategy from Vivek Ramaswamy to criticize the RNC chair, call for her resignation on the stage, ask for replacement moderators, all before answering a question. What did you make of the approach?
He was trying to attract attention, and he was trying to be the Donald Trump, the new Donald Trump of this election cycle. Ain't ever going to happen. And he was so extreme that he was in orbit. And I think it was more orbiting Mars than it was Earth. I think he hurt himself with anybody who isn't in that little niche that he appeals to. And it is a small niche. I mean, he's at 6-7% in most of the polls, and polls can change, but you're not going to go from 6 to 7% to, you know, a large plurality and win the nomination.
Larry Sabato with us. Before I let you go, Larry, I want to bring people back to the tweet of yesterday. Clearance sale. This is in the wake of a very difficult night for Republicans in Virginia, specifically Glenn Youngkin, who was even said to be basing presidential aspirations on the outcome of these elections. You wrote clearance sale, all Youngkin for president, 24 merchandise, a free MyPillow comes with all purchases over $1, no returns. Larry, we got another rough headline shortly after you made that tweet. The FBI headquarters is going to Greenbelt, Maryland, not Virginia, as he was hoping. Is this the worst week of his political career so far?
Well, it's been a very short political career, but yes, it has been the worst week he's had. I understand that objections are being raised, severe objections implying corruption. And I think the Washington Post is breaking a story on this. Maybe already has done so, but will shortly. So people might want to pay attention. I don't think that Maryland is going to get it quite as easily as they thought, and this might cause a reconsideration. So pay attention.
Wow. You just heard it straight from Larry Sabato. Great to have you back, Larry. From the University of Virginia Center for Politics, Jerry Connolly, the congressman from Virginia, tweets, lacking even the basic courtesy of a heads up, GSA has reportedly decided on a Maryland site for the new FBI headquarters. If this sounds strange to you, this has been going on for a very long time, as the existing FBI headquarters sitting a few blocks away from where I am now on Pennsylvania Avenue literally crumbles into dust. And this has been a long-running dispute that came down to 2, Maryland, Virginia. There was even a basketball match, I believe, set up there, threatened between Glenn Youngkin and Wes Moore. Let's assemble our panel for their take on the debate. Rick Davis and Jeannie Shanzano are with us, Bloomberg Politics contributors. I won't pull you into the FBI headquarters debate quite yet, but I'm deeply curious to know. Of course, we were watching, so you didn't have to. Are people talking about this in the office, Jeannie, this morning? You know, usually after the debate, everybody's, the water cooler talks about who won. Does anyone care with Donald Trump not going? I can't hear poor Jeannie. Is that me or Jeannie? Somebody talk to me here? Did I lose? All right, Rick, what do you think on this one? Donald Trump doesn't show up. We know they got a few million to watch these debates, at least the first few of them, but it doesn't have that mainstream impact without his presence, does it?
Yeah, I think Larry Sabato is right. Won't be the first time I've agreed with him that Donald Trump's the big winner of these debates. Obviously, there's been some uplift for Nikki Haley in the 2 previous debates, put her back on track as a campaign, doing well in Iowa and New Hampshire, really significant movement in New Hampshire. And you pretty much have to assume it's both her performance on the stump and her performance on the debates. So it's had some positive impact, but you don't see anybody using the platform, millions of people watching. You can parse how many, but it's a platform where you can communicate to a lot of Republicans who probably are the only ones who watch these debates, to contrast with Trump. And as Larry said, I mean, other than getting asked the first question, I looked at how much time was spent on each issue, and time spent on Donald Trump was less than time spent talking about Venezuela. Now, I don't know about you, but I don't think Venezuela is a big issue in this campaign, but for sure Donald Trump is. So again, I think these guys are just missing opportunities to get in this game.
Well, I'll tell you what, certainly Ron DeSantis and Nikki Haley were being scrutinized last evening. They both showed up, Jeannie, to the fight. Vivek Ramaswamy had his own strategy, it seemed. I wonder if you think anybody moved the needle. Will Ron DeSantis be at center stage, Nikki Haley at his side when we do another one of these?
That's the way it should be. Clearly, if anybody has got a shot for second place, it is those two. The other 3 really don't have a shot. And so, one thing that made this debate better for those of us who watched it was there were fewer people on the stage. They all got more time. I have to tell you, I was really of 2 minds on this. On the one hand, it was really, really depressing because it was a substantive debate, and yet not one of these people is polling in any way that can best Donald Trump. And so, it is depressing because then you think about it. Donald Trump was 11 miles outside of Miami talking about his love for Hannibal Lecter. It was very bizarre. And he has the shot of being president. And these 4, and I too am going to accept Vivek Ramaswamy, are really people who have a lot to say on critical issues. It was a substantive debate. I think DeSantis and Haley performed very well. I give the moderators credit. It was well done. And yet, what was the size of the audience? And do any of these people have a shot if Donald Trump is this juggernaut? So it is a bit depressing to think of it that way. And the only person who'd be in the cabinet is Vivek Ramaswamy. And I'm not even going to get started because that was a whole mess right up there with Vivek Ramaswamy last night.
Well, as I mentioned, he came with a peculiar strategy to attack the host of the party, essentially, in RNC chair Ronna McDaniel. Here he is.
Let's speak the truth. I mean, since Ronna McDaniel took over as chairwoman of the RNC in 2017, we have lost 2018, 2020, 2022, no red wave that never came. We got trounced last night in 2023. And I think that we have to have accountability in our party. For that matter, Ron, if you want to come on stage tonight, you want to look the GOP voters in the eye and tell them you resign, I will yield my time to you.
That never did end up happening, Rick. But in our last moment, I don't know if you caught these two off the side of the stage later, but they were having a very intense conversation. Did he just talk himself right out of the Republican race?
I think he's been talking himself right out of the Republican race. I mean, when you start at 0 and, you're able to make yourself to a few single digits, your message isn't connecting. But I agree with him on this. Ronna Romney should leave. She's a lousy, chairman of the RNC, and all she knows how to do is lose.
Wow. Jeannie, I don't know if you want to add to that, but we have a few other things to get through here, and we will have time. Is Ronna McDaniel going to be the chair of the RNC after this cycle?
No, she should not be. You can't lose this much. But interestingly, he didn't blame Donald Trump, the head of the party, for any of those losses. By the way, all his attacks in those first 2 questions were against women, despite the fact there were men on the stage and off who, if he was being honest, should have been at the end of those, receiving end of those attacks. Very distressing.
Well, we're going to get into the performance of the 2 front runners coming up next. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 121 on Wall Street. We do check markets all day long. Here at Bloomberg, the Dow, the S&P, NASDAQ, they're in the red. Stocks pushing lower as bond yields jump. Traders are awaiting further insights from Fed Chair Jay Powell on the outlook for rates amid a heavy schedule of Federal Reserve speakers. As Powell gets ready to take center stage during a panel at 2 p.m. Wall Street time, traders will be seeking clues on how the moves in longer-term treasuries could impact policy and whether the Fed chief will try to rein in the market's dovish bid. We'll have his remarks for you live right here on Bloomberg Radio. S&P right now down 12, drop there of just about 0.2%. We have got the Dow Jones Industrial Average lower by 94 points, down by about 0.3%. The NASDAQ Composite Index down 33, a decline right now of 0.2%. 10-year yield 4.61% with the 2-year 4.96%. Spot gold up $13 the ounce at $19.63, and West Texas Intermediate crude up 1.7% right now, $76.58 a barrel on WTI. Walt Disney Company shares, they're up 7.4% right now after earnings, and Bloom Energy is surging after the hydrogen fuel cell company reported better than expected adjusted earnings per share for the third quarter. Bloom Energy up now by 12.1%. Recapping stocks lower, S&P down 10, drop there of 0.2%. 37 minutes to go until we hear from Fed Chair Jay Powell. I'm Charlie Pellet. That is a Bloomberg Business Flash.
This is Bloomberg Sound On with Joe Matthew on Bloomberg Radio.
So the high heels did come up in the debate last night. You know, we were all watching for it, listening for it. It just didn't come up exactly the way we expected. As we've been discussing with the panel, Rick Davis and Jeannie Shanzano, Vivek Ramaswamy showed up with his sights set on Nikki Haley. And that's where the heels were invoked.
Do you want a leader from a different generation who's going to put this country first? Or do you want Dick Cheney in 3-inch heels?
All right, Mr.
In which case, we've got 2 of them on stage tonight.
Thank you. Senators.
Going after her foreign policy credentials. Dick Cheney, he said, in 3-inch heels. She was ready for it.
I'd first like to say they're 5-inch heels, and I don't wear them unless you can run in them.
We've got 2 of you on stage.
The second thing that I will say is I wear heels. They're not for a fashion statement. They're for ammunition.
No, I'm not sure about the ammunition. Are we throwing heels around now? Are we kicking people on the trail? But, of course, the fashion statement referring there to Ron DeSantis and the lifts inside the cowboy boots. We never did get to the bottom of it. He stayed quiet through that whole thing. But look, a lot of people are up on Nikki Haley again. She seems to do well in these forums, and then the day after gets a little bit of a bump. We'll see how the panel feels about it. Rick and Jeannie are back with us, Bloomberg Politics contributors. I could play you more from both of them, and I will. The Vivek-Nikki rivalry here, Rick Davis. But I wonder if you think she actually moved the needle for herself, or if Ron DeSantis will still be center stage in the next debate.
Yeah, I think she did well for herself. I think people are watching to see if she's got what it takes to be president. She certainly made a good pitch in the first hour of the debate to be commander-in-chief, right? That's one of the boxes that everybody has to pass in order for Republicans in this case to have confidence in putting them in the Oval Office. And I would say, too, pretty deft handling of the social issues we talked earlier in the program about abortion. Thought she actually got away with something there. I'm a little surprised the other pro-lifers on the stand didn't really go after her. But other than Ramaswamy, there didn't seem to be a whole lot of appetite to take her on. So in that regard, I think she got through the debate very well and will continue to move up as people look for options to Donald Trump. I would say that DeSantis comported himself pretty well from the point of view of he's in a different lane than she is, right? I mean, she's in the interventionist foreign policy lane. He's in the protectionist, don't get engaged around the world. And when he got asked questions about foreign policy, he turned it back to the border And that is a very popular thing to do for most Republican primary voters. So even though we are left scratching our heads going, why doesn't he answer the question? The answers he's giving will resonate with some Republican primary voters, especially those in Iowa.
You seem like he's getting better at this, Rick. I know it might be too little too late, but it did seem like his best performance so far.
Yeah, look, I think he's just the talking point candidate. I mean, he's good at like just hammering around talking points. He doesn't tell stories. He doesn't, talk about people's values. He doesn't put it into context. He just blurts out, sort of talking points. And his talking points are poll tested, right? And so he's hitting those numbers, in order to get voters to take a look at him in the way that they want a candidate to talk. He's uninspiring, but on message. And I'd say that's the nicest thing I can say about his performance.
I'd like to hear from you on the issue of abortion and what we heard around the stage last night. Jeannie, as I was discussing with Larry Sabato, this did not come up for 90 minutes, which is noteworthy after the role that this issue clearly played in the elections of the day before that did not go well for so many Republican candidates. Senator Scott went to the 15-week ban. We heard quite a bit about that. Ron DeSantis didn't go too far into this, even though a 6-week ban was signed in the state of Florida. He was a little bit more vague on things. And Nikki Haley, as we played earlier, said, I won't judge anyone for being pro-choice, but I am unapologetically pro-life. Did she win the messaging on that issue last night?
I think Democrats still win the messaging on that, but out of the 5 of them, certainly Nikki Haley had a very strong answer on that. She said, I am pro-life because my husband was adopted. I had difficulty conceiving. It's personal for me, and I'm not, to your point, going to judge people who have a different view. She also said, rightly so, what the reality is. There aren't 60 votes in the Senate to get a federal ban. This should be left to the states, and in that respect, she was similar to Chris Christie. And I would note there were a lot of issues on which Nikki Haley and Chris Christie on that stage last night lined up. But the problem for Republicans remains, as a whole, they cannot figure their way out of this issue. And it is going to continue to drag them down. And we heard this from Tim Scott last night. They are mistaking this idea. They still are clinging, like Glenn Youngkin was, to this notion of a 15-week ban. People don't care whether it's 12 weeks, 15 weeks, 18 weeks about that number and those policy specifics. What they're hearing is you are taking away our rights. You are taking away our ability to get health care. You are trying to have a strong government hand in what we do with our bodies. I don't care whether you say it's 18 weeks, 15 weeks, the number doesn't matter. And that's what Republicans have to grapple with. And it's going to be a really difficult thing for them to find their way around. But I do think Nikki Haley saying a federal ban or a federal limit is off the table is probably the way they're going to have to go. And again, you've got Donald Trump out there responsible for all of this, who is trying to also moderate his views on this. And that is going to be very difficult, even for somebody who talks a lot like Donald Trump, to figure his way out of that conundrum involving the people he appointed to the court who single-handedly overturned Roe.
Well, I'm just going to apologize in advance for this because Donald Trump did speak at a rally last evening, counter-programming. He was also in Florida. And just to give you a sense of how this went, last evening, while these 5 Republican presidential candidates were sparring, albeit not always on policy, this is what was happening at the Trump rally as he was introduced by Roseanne Barr.
Aren't we all fed up with the deep state bull?
Yeah, this keeps going.
We want Trump, the Magador, to kill that bull. And the kill that bull.
I figured I'd stop there. Donald Trump was also there last evening, said he was bored with these debates. Larry Sabato said, though, he won last night. Rick, do you agree?
Yeah, I agree. I think that by avoiding any confrontation with the second choice competition at the debate. He kept them from being able to really do any damage to him. Honestly, I still am dumbfounded as to why nobody on the stage really took it upon themselves to contrast with Trump, other than answering the first question of the night. It's just baffling to me that they basically are giving him a walk on the debates. And so, believe me, if they all attacked him, he'd want to show up for the next one. And so I think that this idea that they're all going to, give, no attention to Donald Trump is ultimately going to be seen after the fact as one of the biggest mistakes of the undercard.
Wow. New Emerson poll out today, Jeannie. We don't have time for the deep dive, but it's a battleground state poll, swing state. Donald Trump beats Joe Biden in Georgia, in Pennsylvania, in Wisconsin, in Nevada, in Arizona. I thought he was the one Joe Biden wanted to run against.
Yeah, he was very concerning. Repeat of the Bloomberg Morning Council, repeat of CNN, New York Times. Now we have Emerson. The numbers we are seeing are not a one-off, and they are not a shock anymore. They are what they are. Biden's team has to be concerned. And of course, let's keep in mind, Trump, as much as he's in the news today, is not necessarily in the news as a candidate. So I look at some of these polls as a reflection of what people are feeling about the country and Biden. When is it a head-to-head matchup between Biden and Trump? And he is really very much in the news for the issues of the day and running. We may see some slight differences there, but Democrats are concerned. Hence, you see Biden heading out to the Midwest to try to shore up some of these states where he is slagging off. And Pennsylvania being a union state, he's very cognizant of that.
It's nothing like hanging out with Rick and Jeannie the day after a debate, right? They're all ours for the hour. Here on Bloomberg Sound On, let's bring you up to date on world and national news before we change the topic here. Nancy Lyons has that in the Bloomberg 99.1 newsroom in Washington. Hi, Nancy.
Thanks, Joe. Treasury Secretary Janet Yellen and her Chinese counterpart are meeting in San Francisco, beginning 2 days of talks aimed at making progress on a whole slew of economic issues. The discussions are designed to help lay the groundwork for an expected meeting between President Biden and Chinese President Xi Jinping next week on the sidelines of the Asia-Pacific Economic Cooperation Summit in San Francisco. Bloomberg's Anne-Marie Hordern has more on Xi's schedule.
He's not only going to be meeting with Commander-in-Chief Joe Biden, but he'll be meeting with executives as well, the CEOs of America's biggest companies. We don't know the exact list, but there's going to be a dinner. There's a CEO summit alongside the APAC meeting, and you can see the likes of Satya Nadella of Microsoft there or Darren Woods of Exxon. So this is really important for Xi Jinping as much as it is for Joe Biden.
Bloomberg's Anne-Marie Hordern reporting. The longest actor strike against film and television studios in Hollywood history is finally over. The SAG-AFTRA union says the strike officially ended at midnight after a deal was reached. The agreement will now go to the SAG-AFTRA National Board to be approved tomorrow. Those familiar with the agreement say it offers protections for actors against AI and an almost 7% pay increase. Global news 24 hours a day and whenever you want it with Bloomberg News Now.
Profits. Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg, and we are 20 minutes away from Fed Chair Jay Powell as he gets ready to take center stage during a panel at 2 o'clock Wall Street time. Traders will be seeking clues on how the moves in longer-term treasuries could impact policy, and whether the Fed chief will try to rein in the market's dovish bid. Treasuries tumbled after a weak $24 billion sale. Stocks push lower. Right now we have got the S&P down 13. That is a drop there of 0.3%. The Dow lower by 99 points now, down by 0.3%. The Nasdaq Composite Index down 34, drop there of 0.3%. 10-year yield now at 4.60%, with a 2-year that's yielding 4.96%. Spot gold up $13 the ounce to $19.63, a gain of 0.7%, while West Texas Intermediate crude oil is up 1.1% at $76.18 a barrel on WTI. Stephanie Roth is chief economist at Wolf Research, and on surveillance this morning, she told us she does see continued gains on inflation.
We think that growth is going to slow down. Our base case is that growth is going to move below trend with a 1 handle in the first half of next year. Recession risks are going to be elevated until the Fed can cut rates.
And you can hear more of the conversation on the Surveillance podcast. You can download it wherever you get your podcasts. Walt Disney up by the most in a year after reporting better than expected profits. Also, it vowed to cut $2 billion in expenses. Disney now up by 7.6%. After earnings, ARM Holdings, you heard the CEO here on Bloomberg, that stock down now by 5.9%. Recapping, stocks lower, S&P down 0.3% ahead of comments from Jay Powell. The 10-year, 4.60%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
You're listening to Bloomberg Sound On with Joe Matthew on Bloomberg Radio.
President Biden leaves the bubble today, the most union-friendly president in American history, on his way to Illinois to meet with, well, the unions. This after the big three cut deals with the UAW. Joe Biden's going to be out there not too far from Chicago to meet with members of the UAW and, of course, appear with the leader of the union, Shawn Fain.
We not only secured a record contract, we have begun to turn the tide on the war on the American working class. And we truly are saving the American dream.
Saving the American dream. And that's the message, of course, from the Biden administration. They're out there for the reopening of a Stellantis plant. More specifically, there's been a lot of news from the world of organized labor. It's not just the big three and the UAW that the president would clearly be taking a victory lap for here, where he became the first president to walk a picket line just a few weeks back with the UAW. But we've got news today. Just look at the terminal. The actors' strike ending after 118 days. Studios and union reached the deal. When do we get our shows back? Not as soon as you might think. Separate story there. But also, how about what's happening in Las Vegas right now? The big F1 race set to kick off in just days, and the Culinary Workers Union, 25,000 members strong on the Strip, threatening to strike against all the big resorts. Well, they're tumbling like dominoes now, if you take a look. Yesterday it was Caesars. Today MGM cuts a deal. We'll see what happens when Wynn reports after the bell. Culinary Workers Union, a tentative 5-year contract of historic nature, we read, given wage increases in the first year and funds allotted to health care and pensions. That, according to the Culinary Union Secretary Treasurer. Let's reassemble our panel for their take on this. Rick Davis and Jeannie Shanzano. Is this a winning message then for Joe Biden? Jeannie, did he roll the dice and win as these strikes turn into contracts and nearly averted strikes lead to historic wage increases?
He did. You know, I was just thinking when you were talking about him going out on that, standing on that picket line, which was controversial at the time. And I think looking back at it now, it was probably the best, 15, 20 minutes that Joe Biden has spent politically in a while, because it seems to be paying off. And again, we say seems because we don't know for certain, but seems to be paying off in dividends. You've got the tentative agreement with the big three in the UAW. You've now got the tentative agreement with the actors and SAG and the culinary workers out in Formula One and everybody who wants to go see U2 out there. Those are all big, big wins for Joe Biden. And we see him today taking advantage of that as he goes out to Belvedere. Thousands of workers going back to work. You've got the Governor Pritzker there. You've got Sean Fain. And, you contrast that with his leading opponent, Donald Trump, spent his time talking to non-union workers and saying really, really bizarre things about how, EVs were, a transition to hell or something like that. And speaking out and down about Sean Fain and the UAW workers and how all their jobs were going to China. Well, now look at where we are. So if these agreements do pan out, and you're talking about these poll results in these swing states, Michigan, Wisconsin, Pennsylvania, Arizona, Nevada, the list goes on. Even a few thousand votes for Biden that swing from Trump or people staying home is a big deal. So I do think this has paid off really well so far for Joe Biden, and we have to see how it moves forward. But he's taking a bit of a victory lap today, and rightly so.
Do you agree with Jeannie on this one, Rick? Does that mean that union members, rank and file, will vote for Joe Biden?
You will not be surprised that I disagree with Jeannie. First of all, Sean Fain, the American Dream now requires you to be a union member to be able to access the American Dream. I don't think so. Look, I think Jeannie actually pointed out the key vulnerability, and that is he's taken a victory lap on something that actually doesn't affect very many people in any of those targeted states. I'm sorry, how many union members are in Arizona, Nevada, and Georgia? 3 of the 6 targeted states that are going to be at play. If Biden loses just one of those, he probably loses the presidency. I don't get it. The issues that are affecting voters today, the reason Joe Biden is losing are things like inflation, and opportunity, and I don't see him talking about those things today. And so until he starts addressing the elephant in the room, which is people's personal economic situation, he's just adding to the Donald Trump playlist of things to criticize. And so, sure, yeah, Donald Trump says some crazy stuff. And in the last 2 months, he's gone from losing to winning. And I think right now, crazy's beaten Joe Biden pretty handily.
Wow. Well, Jeannie, you mentioned it. Let's listen to what Donald Trump mentioned to those auto workers, union workers. This was on the 23rd of October, the former president.
You should not pay your dues because they're selling you to hell. You're going to be going to hell. You're not going to have any jobs. All those cars are going to be made in China, every one of them. You can forget it, Michigan. You can forget it, South Carolina. You can forget it, everybody. All of those cars are going to be made in China.
You're going to hell, Jeannie. Don't pay your dues. That's the winning message?
It's absolutely not. I would prefer, if I had a choice and I was one of those workers, to be with the union, which just struck a tentative, really, really impressive and historic deal on COLA, on pay raises, and on so many issues. So that is where you want to be. That is where Joe Biden is. And let's not forget the next step for Sean Fain and the UAW. It is right down to some of those states that Rick was just talking about, where they are going to try to unionize some non-union shops like Tesla and others. And, this is the reality of where we are today. I would prefer to be on the side of the union and Joe Biden, rather than on, I don't know, Roseanne Barr and whatever she was screaming about, and Donald Trump saying your jobs are going to hell as they strike this historic agreement. And the culinary workers are, by the way, out west, and they are going to benefit if this agreement goes through.
Yeah, we'll see what happens if they get all of these resorts behind them. My God, to think that just to play back this conversation in a couple of years will be a riot, but this is apparently where we stand. Rick Davis and Jeannie Shanzano, Bloomberg Politics contributors, with us here on the Thursday edition of Sound On. And we're not done yet. We're going to go back to Capitol Hill, get some final thoughts from the panel on this new effort to defund, everyone. They've even gotten to the press secretary at the White House. defund the press secretary's office. Maybe that will become law. Don't count on it. Coming up next hour as well, a special conversation with Jay Powell bringing to an IMF forum. This is Bloomberg.
Your company news headlines on Bloomberg Radio.
From Bloomberg World headquarters, I'm Charlie Pellet. We are 7 minutes away from Fed Chair Jay Powell. We will have his remarks for you live here on Bloomberg. Affirm holding shares are rallying after the buy now, pay later company posted fiscal first quarter revenue that beat estimates. Affirm up now by 18.9%. Virgin Galactic shares are pushing higher after the space travel company boosted its revenue forecast for the fourth quarter. Space right now rocketing higher by 21%. Amazon is going to expand grocery delivery while resuming supermarket openings. And with more on the story, here's Bloomberg's Denise Pellegrini.
Charlie, the retailer plans to open new Amazon Fresh stores next year. And it says Whole Foods delivery is coming, quote, in the very near future. Now, this expansion is part of a grocery reboot reported by Bloomberg over the summer. Amazon, of course, has a large online grocery business business that sells household staples, paper towels, cleaning products, and you name it. But in recent years, the Seattle-based company has expanded into physical stores. It's an acknowledgement that many of us prefer to grab food in person. And in addition to Whole Foods, the company operates convenience stores and Amazon Fresh's supermarkets that it began opening during the pandemic. Charlie.
And that's Denise Pellegrini reporting we've got Amazon shares down now by 0.7%. Walt Disney gaining the most in a year after reporting better than expected profits and vowing to cut $2 billion in expenses. Shares of Walt Disney up now by 7.3%. Those are some of our top company stories at this hour, and this is Bloomberg.
This is Bloomberg Sound On with Joe Matthew on Bloomberg Radio.
We are live from Washington, where we'll add Kaylee Lyons to the conversation coming up in just 5 minutes. And before we have some final thoughts from Rick and Jeannie, let's get up to date on world and national news from Nancy Lyons in the Bloomberg 99.1 newsroom in Washington. Hi, Nancy.
Thanks, Joe. The U.S. says Israel has agreed to pause fighting in parts of northern Gaza for 4 hours every day so that people can exit. It's a request the Biden administration has made for days as the civilian death toll in the war with Hamas keeps rising. National Security Council spokesman John Kirby says the U.S. understands that Israel will start that process today. He's referred other questions to the Israeli Defense Forces. Chairman Dick Durbin of the Senate Judiciary Committee did not get very far today when he proposed issuing subpoenas to 2 benefactors of conservative Supreme Court justices, real estate developer Harlan Crow and lawyer Leonard Leo. Bloomberg's Irv Chapman with the latest from Washington.
Chairman said the Supreme Court won't adopt a code of ethics until Congress demands it.
The reputation of the court is at an all-time low. How can we possibly justify that out of the entire federal government, there are 9 individuals who are exempt from responsibility to disclose lavish gifts and trips?
Republican Marsha Blackburn.
You're going after them because right now you don't agree with some of the decisions that are coming out of the court.
Senator Blackburn asked for subpoenas of administration personnel in regard to issues from immigration to financial regulation. In Washington, Irv Chapman, Bloomberg Radio.
President Biden is in Illinois this afternoon to emphasize his support for unions. He's touring a newly reopened Stellantis plant and meeting with United Auto Workers President Shawn Fain. Well, the union representing Hollywood actors has finally reached a tentative deal with studios valued at more than $1 billion. In Los Angeles, the news of that deal brought loud cheers and tears of joy as the many out-of-work actors felt like their months on the picket lines were finally rewarded. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. Now back to you, Joe.
All right, Nancy, thank you. Things have been busy on Capitol Hill, of course, not only trying to fund the government and avoid a shutdown a week from tomorrow, but many amendments, many motions to defund people we don't like. We had one defunding the office of the vice president for salary and other expenses. Also, the House voting down a move to reduce the White House press secretary's salary to $1. This was brought forth by Claudia Tenney, Republican from New York.
Mr. Speaker, I rise today to offer an amendment to reduce the salary of Karine Jean-Pierre, the White House press secretary, to $1. Mr. Speaker, during Ms. Jean-Pierre's tenure as press secretary, she has repeatedly lied to the American people and acted in a condescending manner toward reporters and also violated the Hatch Act.
See, I thought that being condescending to reporters might actually help the Republican conference in the House. Rick Davis and Jeannie Shanzano, your thoughts on time well spent here on the House floor. Rick, this is what it's come to. There'll be another one later on to defund Rick Davis if they don't agree with what they hear on the show today. Is this just the new look for the U.S. House?
Yeah, it's just another twist on angertainment that we've talked about. They take these votes and then they rush to their, phones so they can tweet it out as quick as they can. Look what we've done. Of course, none of this stuff will ever be signed into law, and it just delays actually funding the government, doing the work of the government. So, I actually hate spending even 2 minutes talking about it because it's just a complete waste of time.
Well, this is why people think Washington is ridiculous, right, Jeannie? We're going to pay the press secretary $1 for being mean to reporters?
That's right. And this is somebody, Claudia Tenney, endorsed by Donald Trump, who posted photoshopped pictures after Speaker Nancy Pelosi's husband was beat up and sent out tweets saying, or a Twitter account saying lots of laughs on these. So, but she's deeply concerned about people being condescending and lying. It is an attempt for her to get advertising. And I would fight viciously against any attempt to do this to Rick Davis. Let me just say that. So
I know you would.
You
guys, in the end, have each other's backs. Rick and Jeannie, hour 2 of Sound On right now.
Now, from our nation's capital, this is Bloomberg Sound On.
2 major stories that we're following here developing before our eyes.
What does it say about Trump's influence on the Republican Party?
What can the Biden administration do on its own to support Israel?
Bloomberg Sound On. Politics, policy, and perspective from D.C.'s top names.
The Republican caucus is at war with itself.
Members of Congress would have a press conference every day if somebody would cover them.
There is bipartisan support for Israel.
This is one of the big ones we only see once every decade or 2 decades in the Middle East.
Bloomberg Sound On with Joe Matthew and Kaylee Lines on Bloomberg Radio.
8 days to a government shutdown and no plan yet. Welcome to hour 2 of Sound On. As the Senate prepares to jam the House, we'll have the latest from Capitol Hill with the help of Bloomberg's Laura Davison and Mike Dorning. And this hour, Fed Chair Jay Powell taking part in a special panel discussion at the IMF's annual research conference. You're going to hear him live in just a few minutes here on Bloomberg. So thanks for being with us today on the radio, on the satellite, and on YouTube. Search Bloomberg Global News, and we'll meet you here in the studio after we get an update on Wall Street. We do that right now with Charlie Pellet in New York. Hey, Charlie.
Hi, thank you very much, Joe Matthew. Indeed, just getting a look at Powell's remarks. Powell says the U.S. Central Bank will not hesitate to tighten policy further if appropriate, and Powell will reiterate that the central bank is not fully confident that it has tightened enough to return inflation to 2%. Stocks at the lows of the day right now, with the S&P 500 index down 25, down 0.6%. The Dow down 184, drop there of 0.6%. NASDAQ down 80, a drop there of 0.6%. 10-year yield 4.61%. The 2-year 4.98%. Yes, we will have Powell's remarks live coming up on Bloomberg Radio. Spot gold $19.59 the ounce, up 0.5%, higher by $9.50. West Texas Intermediate crude up 0.9%, 76 even a barrel. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you. Welcome to hour 2 of Bloomberg Sound On. I'm Joe Matthew in Washington, alongside Kaylee Lines. Nice to see you.
Likewise.
As we count down, it's 8 days. Did I have that right?
8 days until funding runs out.
There you go.
And then the government would shut down a little bit after that.
So it's kind of a week and change.
Right. Not a lot of time.
And a week from tomorrow, we'll have the real countdown clocks going here. Unless, of course, it's laddered CR, which now is part of the nomenclature.
Yeah.
When various agencies expire at various times.
Because
maybe
why
we'll
not
have,
make it more complicated?
I have a vision of just countdown clocks all over the screen with each.
Perfect.
Laura, are you with me on that countdown? You know, we've got the ticker on Bloomberg. We've got the data. We'll cover our faces now with countdown clocks and just watch each agency come to a halt. Does that work for you?
I'm just imagining all of the government funding analysts at OMB just scrambling, the Office of Management and Budget, the people who are in charge of where the money goes and how it goes. And I think that is both highly likely to cause them a lot of headaches, as well as for us, or just the American people, to get very confused.
It also probably causes a lot of headaches for, say, Laura Davison, who is a politics editor
yes,
for us
right.
here at Bloomberg.
I hope this is not going to happen, actually. I don't think it is going to happen. Hakeem Jeffries doesn't either. So I'm going to start with what Hakeem Jeffries said about the laddered CR today, and then we can run with this. Here's the Democratic leader in the House a short time ago.
Most members of the House Republican Conference have no idea what a laddered CR means, what it represents, or how it would possibly be implemented, let alone the American people. The notion of a laddered CR is another extreme right-wing policy joyride that is reckless and would only crash and burn the federal government. It's a non-starter.
Crash and burn the federal government, Kaylee, a non-starter. that doesn't sound like the preferred path. So what's really going on here is we're slowing everything down to go through, I guess, a series of messaging bills.
Perhaps, and we know that time is short. And Laura, it begs the question of whether ultimately it's not going to come down to what the House wants. It's going to come down to whatever the Senate sends to the House, and then the House is just going to have to pinch their nose and swallow it or be blamed for a government shutdown. Is that how this is going to go?
This is really what the new House Speaker, Mike Johnson, remember he's only been on the job for a couple weeks now, is going to, if he hasn't learned it, he's going to learn it soon. And this is how Washington works. Of the Senate, it's the more senior body. It gets a broader say. Remember, there's also a Democrat in the White House. So Republicans aren't going to get what they want, and they're going to have to figure out, just sort of what level of compromise they're willing to get to.
So to your point, the Senate jams House. Here's Chuck Schumer.
In a little over a week, the federal government will shut down if Congress does not come together to pass a bipartisan extension of funding. Today, I am taking the first procedural step for the Senate to move forward on a legislative vehicle we can use next week to pass a temporary extension to avoid a government shutdown.
So does the Senate save the Speaker, or are we actually looking like we might shut down for a few days here?
There's a handful of people who are on the inside who think that a shutdown is very likely. It's not just government funding. We all sort of know that we're not playing with the different levels of government funding. It will be a continuing resolution. They're going to keep the budget more or less where it is, and it's just, some point either weeks or months into the future. The issue is this Israel-Ukraine border, maybe some Taiwan funding that they're trying to figure out as well. They haven't been able to, and sort of this is a forcing point for them to come to a deal. The president, as he was leaving on a trip today, said, he's like, this is so bizarre. I don't understand why we can't come to a deal on this. Basically everybody agrees on funding for Israel. Ukraine is a little bit more controversial, but also on border security, that's sort of the give and take. If Democrats get Ukraine, Republicans get border security, but a compromise has not yet come to fruition, and probably won't until next week because Congress leaves town today.
Right. Veterans Day celebrated tomorrow. So, take 3 days. Don't worry about the clock.
Fine.
Go home for the long weekend. We'll just regroup.
There's not a lot to do.
Next week. Of course, we've been here before. We've been here before many times. Most recently, we were here right at the end of September when we were first trying to avert a government shutdown this year. And we know the ultimate cost of that aversion, the can getting kicked down to November 17th, was that Speaker McCarthy lost his job. Is Mike Johnson going to be granted more grace here?
He's been granted so far a little bit more grace than McCarthy, and he sort of, the day he got the job, or the day before he got the job, said, look, my first act will be to do the same thing that got McCarthy ousted.
Right.
But this question is, if there's only a continuing resolution into January or maybe the spring next year, how long does he stay in the job? He's got a little bit of a honeymoon period now. He's a little bit less known. He's built up some goodwill from members of his caucus who don't want to go through what we went through a couple weeks ago of trying to find anybody to be Speaker. But at some point, you've got, again, the same rules that ousted McCarthy. One person can call up a vote. It only takes, 3 or 4 Republicans to oust him if Democrats go along. So it's going to be everyone's just sort of on this tightrope for weeks, if not months, to figure out where this goes.
And of course, Speaker Johnson wants to see some cuts, or at least his conference does, in whatever continuing resolution might pass. And, they've got some ground to stand on here, considering the deficit and debt issues that we're dealing with. And I suspect that we're going to hear about that quite a bit right now from Jay Powell, among other issues. Laura, great to see you, and thank you for helping us get ready for the IMF's annual research conference now. Fed Chair Jay Powell. Let's listen live on Bloomberg.
So I'll begin by briefly addressing the U.S. outlook, and then I'll turn to 3 broader questions raised by the historic events of the pandemic era. So to begin, U.S. inflation has come down over the past year, but remains well above our 2% target. My colleagues and I are, of course, gratified by this progress, but we expect that the process of getting inflation sustainably down to 2% has a long way to go. The labor market remains tight, although improvements in labor supply and a gradual easing in demand continue to move it into better balance. GDP growth in the third quarter was quite strong, but like most forecasters, we expect growth to moderate in coming quarters. Of course.
Jerome Powell, by refusing to treat climate change like a systemic risk,
thank you.
You are putting us at
Thank you very much.
disaster.
Thank you very much.
Climate change
Yep.
will
Thank you. Just close the fucking door.
Live sound of protesters heckling Jay Powell here at this IMF conference. This is happening as we speak here in Washington. We'll keep an ear on things for you.
Yeah, and of course, Joe, this has happened to the chairman before. In an interview he had with David Weston, the host of Wall Street Week, they also were briefly disrupted by climate protesters. This is actually something that the Fed chair has had to deal with quite often.
Yeah, and look, anyone who's ever testified on Capitol Hill kind of knows what this is
true.
like recently, depending on the issue and the topic that's being discussed here. I guess they've brought down that feed, Kaylee, so we may not be hearing or seeing Jay Powell for a moment as they clear the room here. This was, again, part of an IMF conference. We're not sure exactly what he's going to be delivering in terms of headlines, but this could be a pretty newsy conversation if we get to it.
Well, and of course, the text of his speech was made public at the beginning of this panel. So we do know a little bit about what he intended to say, including that he is not confident that the Fed has achieved a stance that will get them to 2% inflation. Remembering that is the goal. They want to get inflation down to 2%. We are not there yet. They have hiked rates 11 times in an effort to do that. And while the market believes that they're not going to hike again, that they've done enough work, the tightening will continue to kick in, that ultimately they will be able to reach the target, the Fed chairman is essentially suggesting that if they need to go again, the Fed will not hesitate to tighten further if it's appropriate. So he's kind of saying, look, we might not be done yet.
Long way to go are the words that jump off the page here when you look at these headlines. Kaylee, inflation has given a few head fakes, he says, and that could continue to be the case when we talk about Ukraine and Israel here on this program. Typically, from a political standpoint, they have massive economic repercussions, certainly when it comes to the energy market, but beyond that, when we remember what happened to grain prices at the beginning of the war in Ukraine, that was a head spinner for the Fed. You can't plan for that kind of stuff.
Well, that's absolutely right. And even without those kind of exogenous factors that could factor into it, it's just a demand problem in the U.S. as well. Consumers are still largely spending, and it's kind of unclear when that's going to slow down in a more material way. We've seen continued upside, surprises on things like retail sales, and until demand materially comes down, you're going to keep seeing these pricing pressures. So it's all to say, Joe, that a lot of the hard work may still be yet to come, because getting from 8% inflation down to, 4%, maybe that was the easy part, and it's getting from 4 to 2 that ultimately is going to be hard, and there could be a lot of choppiness on the way, and this is a data-dependent Fed. So if a data point suggests to them that inflation's heading in the wrong direction, then maybe they keep the tightening going.
Well, that's true, and you're forecasting things into an election year, and if all that coincides the second half of next year, it's going to be wild times for Joe Biden and whomever the Republican nominee ends up being. So thanks for joining us. If you're just coming along here, it's Sound On, Thursday edition. Joe Matthew and Kaylee Lyons. We were listening to Jay Powell for a brief moment at an IMF panel before it was interrupted by a protester or protesters, so they're taking a break there to reset things, and it's a chance for us to bring you up to date on Wall Street trading. Charlie Pellet standing by with the latest in New York. Hey, Charlie.
Well, hello there, Joe Matthew. Indeed, the Dow, the S&P, NASDAQ, all in the red. Worst level of the day. Recapping, resetting. Climate protesters interrupt Jay Powell's speech at the International Monetary Fund. They have cleared the room. They will resume when order is restored. But the Dow, the S&P, NASDAQ right now very much in the red. Treasuries tumbled. Stocks pushed lower after Powell threw cold water on Wall Street's dovish bid by saying officials are not fully convinced they have tightened enough. Wall Street has also been closely watching the latest bond sales, a test of the market's ability to accept a higher issuance. Shortly after today's weak auction results, 30-year yield spiked as much as 22 basis points, and the S&P 500 index extended losses in another sign of how those sales have been exerting a growing sway over markets these days. So here's where equity markets stand right now. We have got the S&P 500 index down 28 to 43.54. That is a drop of 0.6%. Dow Jones Industrial Average down 200 points, down now by 0.6%. The NASDAQ Composite Index down 91 points, a drop there of 0.7%. 10-year yield 4.62%. The 2-year 4.99%. We've got spot gold up $8.50 the ounce to $19.58, higher by 0.4%. And West Texas Intermediate crude is up 0.9%. 76.02 Brent crude, the global benchmark, which was below $80 a barrel yesterday, now up by 1%. at $80.30. We've got Bitcoin up by 2% now, 36,301 on Bitcoin. So bottom line here, the Dow, the S&P, NASDAQ, all in the red as climate protesters interrupt Fed Chair Jay Powell's speech at the International Monetary Fund. And when things resume, we'll have his remarks for you live right here on Bloomberg Radio. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Hey, Charlie, we do appreciate it. Thanks for being with us here on Bloomberg. I'm Joe Matthew in Washington alongside Kayleigh Lyons. It appears Chairman Powell has made his way back to the podium. Let's listen live on Bloomberg.
The labor market remains tight, although improvements in labor supply and a gradual easing in demand continue to move it into better balance. GDP growth in the third quarter was quite strong, but like most forecasters, we do expect growth to moderate in coming quarters. Of course, that remains to be seen, and we are attentive to the risk that stronger growth could undermine further progress in restoring balance to the labor market and in bringing inflation down, which could warrant a response from monetary policy. The FOMC is committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation down to 2% over time. We are not confident that we've achieved such a stance. We know that ongoing progress toward our 2% goal is not assured. Inflation has given us a few head fakes along the way. If it becomes appropriate to tighten policy further, we will not hesitate to do so. We will continue to move carefully, however, allowing us to address both the risk of being misled by a few good months of data and the risk of over-tightening. We're making decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity, inflation, as well as the balance of risks, as we determine the extent of additional policy firming that may be appropriate to return inflation to 2% over time. And we'll keep at it until the job is done. So with that, let me turn to the three questions that I've posed that have arisen from the receding but still elevated inflation we're experiencing today. The first question is, with the benefit of 2.5 years to look back, what we can say about the initial causes and ongoing policy implications of the current inflation. After running below our 2% target over the first year of the pandemic, core PCE inflation rose sharply in March 21. Economic forecasters generally did not see this coming, as shown by the February 21 survey of professional forecasters, which showed core PCE running at or below target over the subsequent 3 years. So the real-time policy questions for policymakers were what caused the high inflation and how policy should react. And at the outset, many forecasters and analysts, including FOMC participants, viewed the sudden upturn in inflation as mostly a function of pandemic-related shifts in the composition of demand, a disruption of supply chains, and a sharp decline in labor supply. The resulting supply and demand imbalances led to large increases in the prices of a range of items most directly affected by the pandemic, especially goods. In this view, as the pandemic abated, our dynamic and flexible economy was likely to adapt fairly quickly. Supply disruptions and shortages would diminish, labor supply would rebound, aided by the arrival of vaccines and the reopening of schools, elevated demand for goods would shift back to services, inflation would ease reasonably quickly without the need for significant policy response. Indeed, although monthly core PCE inflation spiked in March and April of 21, beginning in May, it declined for 5 consecutive months, providing some support for this view. But, of course, in the fourth quarter of 21, the data clearly changed amid waves of new COVID-19 variants, with only gradual process in restoring global supply chains and relatively few workers rejoining the labor force. That lack of progress, combined with very strong demand from households, contributed to a tight economy and a historically tight labor market and more persistent high inflation. The committee signaled a change in our policy approach and financial conditions began to tighten. Of course, a new shock arrived in February of 22 when Russia invaded Ukraine, driving up prices of energy and other commodity prices. By the time we lifted off in March, it was clear that bringing down inflation would depend both on the unwinding of the unprecedented pandemic-related demand and supply distortions and on our tightening of monetary policy, which would slow the growth of aggregate demand, allow supply time to catch up. Today, these two processes are working together to bring inflation down. The FOMC has raised the federal funds rate target by 5.25 percentage points, and we've reduced our securities holdings by more than $1 trillion. Monetary policy is in restrictive territory and putting downward pressure on demand and inflation. The unwinding of pandemic-related supply and demand distortions is playing an important role in the decline in inflation. For example, wage growth has steadily fallen since mid-2022 by most measures, despite continued robust job gains, reflecting a resurgence in labor supply, thanks both to higher labor force participation and a return of immigration to pre-pandemic levels. While the broader supply recovery continues, it's not clear how much more will be achieved by additional supply-side improvements. Going forward, it may be that a greater share of the progress in reducing inflation will have to come from tight monetary policy, restraining the growth of aggregate demand. Turning then to my second question. For many years, it has generally been thought that monetary policy should limit its response to or look through supply shocks to the extent that they are expected to be temporary and idiosyncratic. Many argue as well that in the future, supply disruptions are likely to be more frequent or more persistent than in the decades just before the pandemic. A second question then is what we've learned about this standard looking through approach. The idea that the response to the inflationary effects of supply shocks should be attenuated arises in part from the trade-off presented by those shocks. Supply shocks tend to move prices and employment in opposite directions, whereas monetary policy pushes each in the same direction. Therefore, the response of monetary policy to higher prices stemming from an adverse supply shock should be attenuated because it would otherwise amplify the unwanted decline in employment. In addition, supply shocks have most frequently come from the volatile food and energy categories, and they've passed through quickly. While food and energy prices critically affect the budgets of households and businesses, the policy tools of central banks work more slowly than commodity markets move. So responding aggressively to quickly passing price increases could exacerbate macroeconomic volatility without supporting price stability. Our experience since 2020 highlights some limits of this thinking. To begin with, it can be challenging to disentangle supply shocks from demand shocks in real time, and also to determine how long either will persist, particularly in the extraordinary circumstances of the past 3 years. Supply shocks that have a persistent effect on potential output could call for restrictive policy to better align aggregate demand with the suppressed level of aggregate supply. The sequence of shocks to global supply chains experienced from 2020 to 22 suppressed output for a considerable time and actually may have persistently altered global supply dynamics. Such a sequence calls on policymakers to use policy restraint to limit inflationary effects. Policy restraint in this case is also good risk management. Supply shocks that drive inflation high enough for long enough can affect the longer-term inflation expectations of households and businesses. Monetary policy must forthrightly address any risks of a potential de-anchoring of inflation expectations, as well-anchored expectations help bring inflation back to our target. The sharp policy tightening during 2022 likely contributed to keeping inflation expectations well anchored. My third question, then, is the level where interest rates will settle once the effects of the pandemic are truly behind us. By 2019, the general level of nominal interest rates had declined steadily over several decades. As the pandemic arrived, many advanced economies had below-target inflation and low or mildly negative rates, raising difficult questions about the efficacy of interest rate policy when constrained by the effective lower bound, or the ELB, as we call it. Over 2 decades, an extensive literature had identified a number of possible changes to the widely used inflation targeting regime, including negative policy rates, nominal income targeting, and various forms of makeup strategies, under which persistent shortfalls in inflation would be followed by a period of inflation running moderately above 2%. Today, inflation and policy rates are elevated, and the effective lower bound is not currently relevant for our policy decisions. But it's far too soon to say whether the monetary policy challenges of the ELB will ultimately turn out to be a thing of the past. The prolonged proximity of interest rates to the ELB was at the heart of the monetary policy review and the changes we made to our framework in 2020. We will begin our next 5-year review in the latter half of 2024 and announce the results about a year later. Among the questions